Grab a seat. Why?
I was thinking like, how is this available? And I'm just gonna ditch.
All the time. Even now, I'm still getting those messages. Is it still available? Yeah, it's available. I just decided after speaking with you guys last night, I decided to be nice, and I just respond with like, yes, it's available.
How can I help you?
How can I help you? Exactly. I was on a tear for sure. But let's get started with the review questions for Unit 11. We're going to begin on page 271. Question 1. Which group of legal instruments may legally be prepared by a licensed real estate broker?
B.
Yeah, because if you look at the other ones, they include promissory notes, right? Deeds, mortgages. So no, it's C as in Charlie. Number 2. Failure to comply with the statute of frauds.
B.
B would have to do with whether the contract is in writing, and that's what the statute of frauds requirement is all about. Contracts that are transferring ownership rights and contracts that are not to be completed within 1 year of the date created, like lease, listing, buyer agreements for a term of longer than 1 year, must be in writing and signed to be enforceable. If something goes wrong, be able to enforce in the court of law. Excuse me. Number 3, which contract does not come under the jurisdiction of the statute of frauds?
A.
Correct answer is yes. Based on what we just got done reviewing, right? If it's less than a year, does not have to comply with that requirement where it must be in writing and signed to be enforceable. Number 4, a valid real estate sale contract. Longest answer, it's A. Contains all of the essentials and is in writing. Number 5, an adult contracting with a minor is an example of failure to meet which essential of a real estate contract? Competent parties, if you're dealing with a minor. Individuals of sound mind and of legal age. A minor is not of legal age. 6, canceling a daughter's debt in a contract due to love and affection is an example of?
A.
Correct answer is A, is an alpha, good consideration. A contract that is not in writing is called parole, verbal, oral. All mean the same thing, that it's not in writing. When a contract has been formed but a obligation remains to be performed by one or both parties, this is an example of C, an executory contract. When a contract has been completed, it's known as being what? Also starts with an E. Executed, yes, that's the difference. 9, which statement is false regarding counteroffers specifically?
D.
It is D. Because the offeror and the offeree do not remain the same when counteroffers are given. If I give you an offer on your property, you don't like it, you submit a counteroffer. Now you become the offeror and I become the offeree. We change roles, positions. We don't remain the same. 10, an offer is not terminated by? D, extension. It's not one way to terminate.
That not.
Not. Yes. Number 11. A closing is scheduled for next week. The broker would like the closing agent to prepare a check payable to the associate for their share of commission. Which statement is true? What did you get? It is D as in Delta. The broker must provide specific written instructions to the closing agent regarding the share of commission to be given to the associate. Number 12. A woman gave an exclusive right of sale listing to a broker to find a buyer for her residential lot. While she was vacationing, a buyer signed an offer to purchase the woman's lot at the full price in terms of the listing agreement. Which statement is true? What'd you get? Correct answer is C as in Charlie. The exclusive right of sale listing does not give the broker the authority to accept the offer on the woman's behalf. But what legal document would? Power of attorney. Not this one, not exclusive right of sale. What's your duty if you receive an offer?
Present all.
Present all offers. We even saw that in a previous unit, right? All offers, counter offers in a timely manner, explaining the details of each to that, buyer and or seller that you're working with. So that listing does not give you the authority to accept the offer on the woman's behalf. But there is a stipulation that you could put in a listing contract. And this is when you practice as a real estate professional, just so you know this for future reference. You can stipulate either present all offers, written and verbal, but I would check off the second box. It says only present written offers. So as a listing agent, you don't want to waste your time with all those people that are just calling you to find out information about the property. Oh, would the seller take X amount of dollars? Oh, I'd be willing to pay that. Okay, put it in writing. Then I'll present it. You don't want to waste your time. And people historically will try to waste your time. Number 13. A woman and a man enter into a written agreement. The man is, of course, going to mow the woman's lawn because we know how the book goes. Every week during the mowing season, every third week during the winter, in the middle of the summer, he can't catch a break, really. He breaks his back. He has back surgery. Hands over his lawn maintenance contracts to a friend who assumes the responsibility for all the man's customers for the remainder of the contract period. What term describes this situation? It's B as in Bravo. Assignment. Assignment of contract. That's what he's doing. He assigns his lawn maintenance contracts to another to take over that obligation. But all parties must sign the novation agreement. 14, which applies to the exclusive right of sale listings?
D.
Yes, all of the above. More than 70% of the time. In this case, it works. 15, which disclosure regarding radon is required when purchasing or leasing real property in Florida? It's D. Simply put, a disclosure statement in the contract explaining radon gas and the hazards of. 16, a real estate associate must disclose to a prospective buyer that it is C. Family room addition does not comply with local building codes. The others are not relevant. We already talked about that in Unit 4. Normally, a sale contract involving real property contains a provision that in case of breach by the buyer, the earnest money deposit will be regarded as B, liquidated damages, in this case to the seller. If the buyer breaches, seller might try to claim the deposit, and that's liquidated damages. 18, the most advantageous type of listing from the broker's point of view is, of course, the exclusive right to sell. C as in Charlie. You're assured a commission regardless of who sells the property. I would say that's the most advantageous. Exclusive agency and exclusive right to sell. Well, exclusive right to sell means no matter who finds a buyer, during the term of that listing contract, you're going to be entitled to a commission. Exclusive agency means your brokerage can be the only brokerage that lists or advertises that property. But the seller still can try to look for a buyer on their own. And if they find one before you, they don't owe you a commission. So 19, which statement is false concerning Florida's building code violation disclosure? Hi, grab a seat. What'd you get? It's A. Seller is responsible for the costs associated with the code violation. Can you buy property with a code violation? Yes, you can. But you have to have knowledge of it, and it has to be disclosed to you, and that's what we see here.
It's hard to prove, like, how you don't have knowledge of it. It's hard to prove that when you bought that policy, you didn't have knowledge.
Yeah, you'd have to prove that they committed fraud or misrepresentation. They left something out to make it completely truthful. And 20, a couple have decided to make a written offer to purchase a home built in the 1950s, which task is not required before signing the sale contract. Correct answer is it's C as in Charlie, yes. Too much
What was
anticipation? It's C as in Charlie. The
What was
couple
number 14?
must have the home inspected for lead-based paint? No. They have to have knowledge of the hazards of lead-based paint. The LBP disclosure must be given to them, but the seller is not taking responsibility for it. Online, you had a question?
What was number 14? Sorry about that.
Number 14, D is in Delta. You had a question?
Thank you.
Is 18B, it's C. All right. Let's move on to the questions for Unit 12. We're on page 230 or 293 now. Question 1. In a mortgage transaction in Florida, the legal evidence of personal debt is the B, the note, the promissory note. Mortgage note must accompany all mortgages in Florida. Can't have one without the other. Yeah. Yeah, it's sometimes called just a note. Sometimes called a bond. It's in the first paragraph, the last sentence of the first paragraph of where we talked about promissory notes. So sometimes it could be called the note promissory note is the official name. Sometimes it's even called a paper. And the reason, well, not the reason, but the occurrence when they call it paper is usually when they're selling the debt. Are you selling the paper? Selling the obligation to repay the debt, essentially. Number 2, a type of seller financing in which the seller retains legal title until the buyer has repaid the debt is contract for deed. Good job. Number 3, in title theory states, which Florida is not, the mortgage clause that provides that transfer of title to the lender is defeated when all the terms of the agreement have been fulfilled is the defeasance clause. You're defeating your debt, and what must the lender do on your behalf? Well, yes, if we live in a lien theory state, which we do here in Florida, release the mortgage lien, remove that essentially, record satisfaction, and that must be done within 60 days. We talked about that as well. We'll have a question about that in just a moment. Or if you live in a title theory state, which is what they're describing, sign the deed over to you once you pay off the debt. Number 4, a home was purchased with a down payment $50,000. Down payment $50,000, loan of $200,000, 6% interest, 20 years, monthly payment does not matter because they're asking us for the LTV, loan to value ratio. And you can take out your handouts for calculation of LTV. And we can plug in the information. We take the loan and divide it by the purchase price or value, and then we get the LTV. It's as simple as that. So do they just come out and tell us? No, they give us enough information to figure it out, though. We said down payment of $50,000 plus the loan of how much? $200,000. And when you add those two figures together, you get, I'm saving that for over here. Sorry, that's supposed to be under the purchase price. 250,000 is, yes, the loan they tell us is 200. So that's the information that we needed. Do you understand how we got this? The loan is 200, they tell us in the question. And then if you add the down payment plus the loan, you get the purchase price. So you take the loan to divide it by the purchase price, and yes, what do you get? 0.8, which is how much percent? 80%. Is this one of our choices? Yep. Correct answer is D is in Delta. 5, a borrower who is in default on a mortgage is allowed to prevent the lender from foreclosing on the property by paying the lender the delinquent principal and interest plus any expenses that they've accumulated in attempting to collect these payments. This right is called equity of redemption. C is in Charlie. The keyword is redemption. You're redeeming yourself, and you have the right to stop the foreclosure sale all the way up to the sale, the auction date. Let's move on. 6. A lender declares all the unpaid balance due and payable as a result of default. The lender is exercising the A, acceleration clause. If you stop paying, the lender with this clause has the right to accelerate the due date to pay it all off. Basically, they say, I want the remaining balance right now.
They don't have to.
No, which is most likely going to lead to foreclosure, right? If they're asking you for the remaining balance and you owe $200,000 left on your debt, it's going to lead to foreclosure, most likely. Unless you can magically refinance or you get a large lump sum of cash from a family member or something, I don't know. But what clause goes hand in hand with this that allows you to get back on track? If they initiate the acceleration clause, what clause allows you to pay some type of penalty and reinstate the original terms? I just gave you the answer. It's called the right to reinstate clause. So we got to go back and we have to review that section, obviously. The due on sale clause means that the debt is due and payable as a result of sale or transfer of title. So imagine you have a loan and it has a due on sale clause. You want to sell the property to me, I can't take over your debt because of that due on sale clause. It prevents you from transferring that debt to me. The debt has to be satisfied with the lender. The debt is due on sale. If you don't have the due on sale clause, then I could potentially take over your debt and be the new borrower. Good question. Number 7, the person who borrows money to help pay for purchase of real property is called at various times the mortgage or, guys. Oops, I don't know. Remember mortgage or and mortgagee? The mortgagor is the borrower who's always poor. That's what they're describing here.
But
And the mortgagee has the money. Yes, that's the lender. The person who borrows money. The person who borrows money, that's the borrower.
I mean, no, I meant mortgagee.
The mortgagee has the money. That's the lender. But they're not describing the lender here. They're saying the person who borrows money.
It said lender and then it said,
They're the mortgagee.
G.
Yes.
Same definition. So how do you-
Show me that, because they're not borrowing, a lender's not borrowing money.
So,
Yeah, but no.
It's in the beginning where they're talking about mortgage or mortgagee.
because like the other one, when
It's on
it's
page,
it's
278.
receiving.
And it says they borrow money? Or they're lending money?
To borrow, it's like BO, so the first O, the second O, and then mortgage or is OO, so that's why. That's right.
I could just share with you this. The person who borrows money, that's the borrower. And
Oh, yes.
they're the mortgagor. Yeah. Yeah, but that's not what they're describing in the question. They're saying the person who borrows money, that's a borrower. That's not the lender. So what is the borrower also called? They're called the mortgagor. Yep. Just be careful with that, because once again, we get caught up with the or and the E, and you're like thinking about the money, who's giving the money, who's receiving it. That's
Yeah.
not the case. Who's giving something? It's the borrower. They're giving the mortgage. They're hypothecating. They're pledging their property along with a promise to repay the debt. And who's receiving that promise? Who's receiving that hypothecation? What's the lender? That's why they're the mortgagee.
Yeah, you can just look at page, just look at page 277. The first
Yeah,
part.
I misread it.
Yeah.
That's okay. No worries. Number 8, when a vendee buys subject to the mortgage, the D, vendee is not responsible for the note. Subject to. You remember subject to? That means the original borrower is still responsible for the debt on paper. So who's the vendor? Do you know who the vendor is and the vendee? The vendor is the seller, the vendee is the buyer. So if it's subject to, that means the original borrower, the seller, is still on the hook. And that's why it says the vendee is not responsible. The buyer is not responsible for the debt. The original borrower, the seller, is. 9, a couple just made their final mortgage payment on their home. What document must be filed on their behalf? C is in Charlie, satisfaction, but within how many days? 60 days, you got it. 10, if the lender does not want the mortgage to be paid ahead of schedule, the lender will impose a prepayment penalty clause that prevents you from paying it early. If you try to pay it early, it discourages you. If you try to pay it early, they're going to penalize you. They're going to essentially fine you. Why would they fine you? You pay it off early.
They make less money.
Prepayment means you can pay off as early as you like. No prepayment penalty means if you try to pay it off early, they're going to penalize you by charging you
That's
some type of
significantly
fee.
less than what they would be paying in interest.
What was that?
Is the prepayment penalty significantly less than what they would be potentially paying back in interest?
It's a good question. I would say it's circumstantial depending on the lender, because the lender, they can impose whatever prepayment penalty they wish. So it's hard for me to say yes definitively. You'd have to look at the documents to determine that. But I'm sure you could do the calculation individually. If you know how much you're paying in interest and you try to pay it off early, and then the charge is X amount of dollars, you can compare the two.
Right.
But number 11, a buyer agrees to purchase a property with an existing mortgage lien. In which situation is the new buyer the only party responsible for the debt? Well, it's assumption with novation. So it's assumption of an existing loan plus all parties, in order to solidify this, have to sign the novation agreement to substitute a new borrower for the original borrower so that the seller can be completely relinquished of any responsibility. 12, the LTV is 80%. A buyer wants to acquire a property with a purchase price of $116,000. Calculate the required down payment. This is a little bit of common sense when it comes to understanding what the LTV is. If you understand what LTV represents, you can easily answer this. LTV, and it's still on your handout, is the percentage of the purchase price that the lender is willing to finance. So what are they telling us in the question? They're saying the lender is willing to finance what percent of the purchase price? 80%. But that's not what they're asking us for. They're asking us for the down payment. So if the loan is 80%, what percent is the down payment? 20. So all you had to do, this is how simple it was. All you had to do was take $116,000, which was that purchase price, and simply multiply it by 20%. And you would have gotten your answer, which is $23,200. Does that match up? You can do that and then go through a few extra steps, which is multiplying and subtracting. And is that what you're talking about? Divided by the purchase price. Yeah, you wouldn't divide by the purchase price. You wouldn't get the same result. This is different from what's on the handout. What's on the handout is the LTV formula and the alternative, working backwards to get the answer. This is not, it doesn't have anything to do with what's on that handout specifically. This is calculating something that it has the same type of information, but it's a little bit different. So it's asking you the down payment. We don't use down payment in the LTV, the loan to value ratio, per se.
Oh, that's I still got
Yeah, so a lot of people, what they do, the only other way is you take 116,000, you multiply by 80%, and then you subtract it, and then you get the down payment. But if you know that 80% is the loan, all you had to do is multiply by 20%. That would have given you the down payment. Just another way to think about it, but that's what I'm here for. 13, the primary purpose of an estoppel certificate is to verify the loan balance. You got it. exactly as stated. 14, when a Liz pendens is filed properly with the county clerk, it becomes a type of constructive notification. Filed properly, recorded in the public records, that's constructive notice. 15, a couple purchased their home for $125,000. They financed the purchase with an 80% conventional loan. The lender charged 2.5 points. Calculate the actual cost in dollars of those points. Now, I want you to be aware of something here. Depending on the wording that they use within the question will tell you what calculation is to be made, what formula is to be applied. Look, out of these two, lenders yield by points, cost in dollars by points. What are they asking us to calculate? Which one? Lenders yield or cost in dollars? It's in the question, yes, and that's why it's included on this handout. So if they say cost in dollars of points, what's the calculation? You have to know this conversion. Each point is equal to 1%. So if it's 1 point, it's 1%, yes. 2 points, 2%. 3 points, 3%. I think you get it. But we want to calculate, and that's on the loan, not the sale price. You'll see it right here. So the points are calculated on the loan, not the selling price. Anyhow, what's the loan? They tell us in the question. Oh, well, actually, they didn't. That's what we're. No, they gave us that information. Indirectly, they didn't just come out and say what it is, but they give us enough information. We know that exactly. The purchase price is 125, right? But was financed with a 80% conventional loan. That's our LTV. That's what LTV represents, the percentage you finance, right? So they just said conventional loan, but it is an LTV. And when you do the math, you get the loan of what? What's the loan? $100,000. And remember, points are calculated on the loan, not the selling price. So we needed the loan first. We got it. This is how we figure it out. The loan is 80% of that purchase price. We multiplied. We got it. Now let's convert those points. It's 2.5 points, but it's a 1-for-1 conversion, right? So 2.5 points would be 2.5 what? Percent. 2.5% of that loan. And this in decimal form would be 0.025. Do the math. Take 100,000, multiply it by 2.5% or 0.025, and you get your result, which is $2,500. Any questions here? Did I lose anybody? All right, so that's cost in dollars. That's an easy calculation. I mean, both are easy, but you got to pay attention to what they're asking you for. Anyhow, let's go back to our textbook, and the correct answer is C as in Charlie. Let's move on. 16, a borrower defaulted on a mortgage encumbering an apartment complex. Once the foreclosure proceedings were filed, the lender appealed to the courts to appoint, most likely, it's a receiver, to collect the income that that property is producing so the owner that's in default doesn't try to pocket the cash. 17, the rule of thumb to convert discount points to annual percentage rates of interest is that each point will increase the lender's yield. You see the key words they use? Look at your handout. Lender's yield, right? And the conversion is here. Each point is 1/8%, right? Does that match up? 1/8%. Let's use that rule of thumb for the next question. A lender charged 7% plus 3 points. What's the approximate yield? We can turn to our handout. So here's the thing. Your true interest rate, what you really qualify for, is 7%. That's what they're describing. But they're also imposing points. How many points was it? 3 points. So if we convert it, this is how we do the math to convert it. It's 3 points. We can multiply by 0.125, and that will tell us the points as a percentage increase. No worries. Come on. You're all good. Thank you. Cheers. Absolutely. Have a great day. What did you get? I'll do the math with you guys. Come on. You take 3, multiply it by 0.125. Everybody should be doing the same math. Nobody should be skipping this. And you get 0.375%. This has a percentage, 0.375%. And now the second step is to add, well, the true interest rate, 7%, plus because they're charging you points and we're converting those points because you can't pay for them up front. They're rolling it into the loan. They're adding it to your existing interest rate. What's your new interest rate? Your adjusted interest rate. 7 point what? 375. Does that match one of your choices? Correct answer is B as in Bravo. All right.
Like this.
3 points for what?
For your, like,
No, that's throughout the entire loan term. That 0.375 added onto your existing interest, that exists throughout the entire loan term. So when you calculate how much more money you're paying in interest over 30 years, most people stretch the loan over 30 years, right? It's a lot of money. It's over 1/3% extra. Just because they chose to charge you points. And that's why I mentioned the best thing you can do is to shop around. Don't stop with the first lender that you engage with and submit a loan application with. That's why mortgage loan originators are helpful, because they have relationships with a multitude of lenders. And they take your one loan application and they shop around for you. And that's why I mentioned you should consider getting that license, because it is a useful license to have. It brings value to the transaction. You're going to look like a rock star. Your buyer is going to be thankful. You're going to get the praise and you're going to get reap the rewards, because of course you can make commission now. Question.
Could it be like something like that?
Of course. If I'm lending money, if I'm a lender, I can impose whatever I want. I can dictate, I can say it's 7.9995% if I want. That's your interest rate. It's what the lender chooses. Now, it's based off of something, and we're going to learn more about what it's based off of in Unit 13. We're going to discuss supply of money, where money comes from. This is very important. Most people don't even think about this. Don't understand the concept of money, what it is, where it comes from, how it exists in our country. Of course, you see the end result, which is you're just a borrower trying to get financing to purchase that house that you really like. But we don't know the process that led to it ending up in your presence, right? I don't want to say in your pocket, because that money doesn't go to you. It goes to it goes to the seller, right, for purchasing the property. But you understand what I'm saying. That's going to be in Unit 13. We're going to take a deeper dive into financing, which is so important. But let's continue to number 19. You have a loan with a monthly principal and interest of $846.21. The lender requires an impound account for taxes and insurance. Property taxes are $2,840. Insurance is $1,570. What's your total monthly mortgage loan payment? Your PITI, P-I-T-I. This is how you figure it out. It's very simple. If you could just focus here for just a moment. Let's start by adding those two figures that they're giving us annual amounts for. Property taxes are paid annually. Insurance, sometimes you pay on a monthly basis. Sometimes you pay every 6 months, like a 6-month premium, but most of the time people pay annually. They renew their policy annually. And they tell us in the question, right? Annual insurance premium. So let's add those two figures together. Well, property taxes, $2,840, annual insurance, $1,570, and you add those two figures together, you get $4,410. I don't know if you calculated that. That's your TI, taxes and insurance, not the wrapper. And then to get monthly, because this is an annual amount, and they're asking us for monthly, how do you get from annual to monthly? You divide by what? You divide by 12. And tell me what you get. Do the math. Everybody should be doing this. I'm relying on you guys. 367.5 or 50 cents? 367.50? Yeah. And this is still our taxes and insurance, but on a monthly. And we add that to our monthly principal and interest, which is 846.21. They share with us in the question, right? And that gives us a total monthly mortgage loan payment of $1,213.71. Is that what you got? That's your PITI. PITI, principal, interest, taxes, and insurance for the whole month. Your total monthly mortgage loan payment, $1,213.71. We didn't talk about mortgage insurance, but we're going to talk about that within Unit 13, which is today. We're going to jump into that in just a moment. And 20, I don't have to show you the math here. I can just explain it to you. If the property value is $350,000 and you leveraged against it, borrowed against it for $300,000, what's left over? What is your equity? $50,000. Correct answer is A as in alpha. All you had to do was subtract, guys. Take 350 minus 300. You got your answer. That's your equity. Any questions here? You can't use the restroom. I mean, we're going to start with our session, but you're more than welcome to use the restroom. I don't want to hold you hostage. All right, 13 and 15. That's today. We're going to start with 13, yeah. 13, as I mentioned, is the longest unit in the textbook. There's a lot of relevant information within this unit, a lot of intriguing things that we're going to discuss, and stuff that when I mention it to you, you're going to be thinking, why didn't I learn that? Why wasn't this taught to me? This is something I need to know for personal reasons. We're going to take a deeper dive into financing. I mentioned that to you. Types of mortgages, sources of financing, loan products that exist that you could take advantage of potentially. Look at all the wonderful key terms we're going to discuss and encounter on page 296. If you're not familiar with the process on page 296, what does it take to obtain financing? This is how it usually goes. You start by submitting a loan what? Application. On the next page, they evaluate your what? And your history, payment history. Qualifying ratios are debt to income ratios. Have you ever heard of debt to income? Yeah, exactly. They take your debt, compare it with how much you make on a monthly basis to determine if you qualify for obtaining financing for a certain purchase price. Okay? We'll talk about this. That's going to be today, and you have a handout for it. Qualifying the property might be part of a specific loan program like FHA and VA. We'll come back to those. And of course, before you go shopping, what do you need in your hand? A what letter? What do you need? You need a pre-approval letter. You don't want to waste your time. So let's get into it. Here we go. And how many days do you have to shop around? 30 days, you got it. Without impacting your credit score. When you pull. Questions? Yes, yeah. When you submit a loan application, of course. Now, they might do an initial calculation with you before they pull to make sure that you're actually qualified. And I'll show you that same calculation that you can do with your buyers, because everybody thinks that they qualify until you actually look at the real numbers. So you ask them, hey, listen, let's look at the real numbers. Tell me what your debts are in the month. How much do you make in the month? Let's compare the two, and then you'll get a percentage. And then based on that percentage, you'll see if they qualify for certain loan programs. This is very useful. So before they have this hard inquiry on their credit report, you can actually come up with a game plan, be strategic, and then imagine they're not qualified when they thought they were because they have too much debt. But they have enough money, they can pay off the car. And then that wouldn't show up on their credit report, which would actually help them qualify for a higher loan amount. So you have to have a upfront conversation with them. you have to play the trust game, essentially. You got to trust me. I'm on the same team as you. You got to share with me the real numbers, and I'll show you if you qualify before you go through this loan application process and blah, 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 and find out that you don't. Or then we have to work backwards, fix your credit after they already impacted your credit score. Let's do it now and then submit the loan application. Buyers are liars. That's all I'm going to say. Let's move on. Conventional versus non-conventional mortgage loans. You see, mortgage loans are grouped into two general categories. Let's talk about it. Conventional, here's the basic difference. Conventional loans are loans that are not backed by the government. No government guarantee or insurance for the lender. So that means if the borrower defaults, the lender assumes a full risk of that default. That's a conventional loan. So you can imagine you have to be a little bit more qualified to get this type of loan because the lender is assuming the full risk of giving you financing. They don't have any guarantee from the government, no backing. The lender's on their own. So the qualification process is a little bit more strict, as you can imagine, versus non-conventional loans, loans that are backed by the government, and there are two in particular that we're going to discuss. FHA insured by the government and VA guaranteed by the government. We'll come back to those. Let's talk about conventional mortgage loan features. The whole purpose of giving you a loan is so the lender can make what off of you? How do they make money off of you? Through what? Interest, exactly. But that's based on your qualifications, of course. Let me run through these features and briefly describe them to you, but I'm pretty sure most of you understand. Assumption. Are conventional loans typically assumable? Look what it says. Fixed rate conventional loans. Most people want to go fixed rate, where the rate stays the same throughout the loan term. Those usually have a due on sale clause, which means what? Which means it prevents another borrower from doing what? Assuming the mortgage loan. However, something interesting. Adjustable rate conventional mortgage loans are assumable, which we'll see later on. Prepayment, you could pay off as early as you like. Nice. Down payment and PMI. Most lenders, especially for conventional, want you to contribute at least how much percent of your own money as a down payment towards purchasing that property. Most want you to contribute at least 20%. You'll see right here. And if the borrower makes a down payment of less than 20%, PMI is required. Private mortgage insurance. Do you see it here? So that means if they offer you an LTV of over 80%, that means the lender is willing to finance more than 80% of the purchase price. That's nice because that means you have more money in your pocket, less of a down payment. Imagine if they give you a 90% LTV. That means you only have to come up with how much percent as a down payment? 10%. But with conventional, if you don't contribute at least 20%, they charge you private mortgage insurance because now you're viewed as more risky. So you had to qualify to get a lower down payment, but when you take advantage of a lower down payment, you're more risky. How does that make sense, right? It's a game. It's so they can make more money off of you, and they know you can pay it. You got more money in your pocket. They're trying to suck all that reserve out of your pocket. Oh, you don't want to give us 20%? Okay. Take advantage of the 10% that you qualify for, but you got an extra, you got some money there. We want that. And it's a slow grind. Every month, the PMI, it's a percentage. But PMI, when I was paying a PMI on was a $320,000 loan, I was paying almost $400 a month. $400 a month for this mortgage insurance to protect the bank just in case I what? I default. It felt like I was just throwing the money out the window. And I had the 20% at the time. I had the 20%, but I wanted more money in my pocket. I don't want to give them all my money towards buying that property. I wanted a cushion. I wanted to do renovations and so forth. A lot of people take advantage of that. Conventional loans, I've seen conventional loans with down payment as low as 5%, but they'll charge you the PMI. Now, it's not forever. Throughout the course of the loan, after 2 years of good behavior, you can request to remove PMI. Save you some money every single month. But you have to do an appraisal on the property. And based off that appraisal, if you have at least 21% equity in the property, then they'll remove it. 21 is after the fact. So 20 up front to not have to pay the PMI. But if it's after the fact, you have to have at least 21% equity. And they don't make it easy for you to remove the PMI. They love receiving that. It's like free money to them. Anyhow, let's talk about LT. Well, we already know about LTV. So what LTV do they typically provide for conventional loans? Well, 80%. Doesn't mean that you can't qualify for a higher LTV, but remember, PMI is required if the LTV is greater than 80%. Any questions on that? Okay, let's move on. Where we see qualifying for conventional mortgage loans, I'm going to come back to this. This is debt to income ratios. These are debt to income ratios. You're going to be tested on one of them. Class exam. You can lock it in now. We'll come back to it. Okay, let's continue on. Yeah, we're good. Go to page 300. Common types of mortgages. Two most common types of conventional mortgage loans are fixed rate amortized and adjustable rate mortgage loans. What does fixed rate mean? Yeah, it means your rate's going to stay the same throughout the loan term. Most people stretch the loan over how many years? 30 years typically. Could it be less? I've even heard of more than that. So people like to stretch it out as long as possible so that way their monthly mortgage payment is less. But then we come across an amortized mortgage. What does it mean, an amortized mortgage? Well, the word itself, amortization, means to systematically kill or deaden. Let me repeat that. Amortization means to systematically kill or deaden. And that's what happens with each monthly mortgage loan payment. If it's an amortized monthly mortgage loan payment, it consists of two parts. What two parts does it consist of? It's right here in front of us. Principal and what? You see it? Principal and interest. Let me explain the difference between these two parts that make up your monthly mortgage loan payment. You remember we talked about PITI, principal, interest, taxes, and insurance? So what is principal interest? The principal is the portion of your payment that goes towards killing your actual debt, your loan. Let me repeat this. Principal is the portion that you like to pay every single month. It's the portion that actually goes towards killing your debt. Interest is the portion that kills you. You got it? This is what's going in the bank's pocket for giving you the loan. That's profit to the lender. That's interest. Now, here's the thing that you might not like, but it's consistent across the board. Amortized mortgages. In the beginning of the loan term, can you guess what makes up the majority of your payment, principal or interest? What do you think? The majority of the payments that you make every single month.
Interest.
Imagine it's $2,000 you pay every single month. Maybe $1,500, maybe more of that 2,000 goes in the bank's pocket. Interest. The lesser portion goes towards actually killing your loan debt. But it doesn't remain like this. What do they do over time? They trade places. So the principal portion of your payment is going to slowly take over, while the interest portion of your payment is going to decrease. They trade places. So your payment stays the same, still $2,000 every single month. But within that $2,000, those two parts trade places. You don't really start killing your debt until the end of the loan term. And that's why people that are frustrated with this and know the game of lending don't make additional payments every single month, but they say apply this payment only towards the what? Principal and not the interest, to kill the debt that much quicker. Now, some people think, oh, if I make additional payments every single year, is that going to lower my loan amount? Yeah, but is it going to lower your monthly mortgage loan payment? No, your payment's still going to be the same. Is your interest rate going to change? No. So what they do is you're cutting down the loan term. You're paying off your debt sooner. So 30 years, you're cutting it down. Now, just to give you a visual of what that might look like, go to page 301. Let me share this with you. This is an example of a $200,000 mortgage loan at 4% interest, 30 years, level payment plan, mortgage loan. Level payment plan means your payment stays the same every single month. Level payment plan. And your interest fixed. 4% is the rate. Look at the first 6 months. Your payment is always going to be the same, but look how much is going in the bank's pocket in the beginning. More than half, right? I think it's, what is that, over a third is going in the bank's pocket. And the lesser portion is actually going towards killing the debt. So in month number 1, 288.16 is going towards killing $200,000. You subtract it, and what are you left with? You're left with that amount. And then you plug it in, do your math all over again and again and again and again. Well, yeah, look, exactly. Fill their coffers, right? And their pockets, their bank accounts. But check this out. From month 1 to month 2, look at the difference. Less than $1. Less than $1 more is going towards killing your debt. It's a painstaking process. It's not overnight. And that's why I mentioned you don't really start killing your debt until the end of the loan term. Look in the end. Payment is still the same. A lot less going in the bank's pocket. A lot more is going towards killing the debt. Now, but it's a common practice. This is what exists. Adjustable rate is also called an ARM. And there's a reason, because it's probably going to cost you an arm and maybe even a flipping leg. Adjustable rate means exactly that. They're going to adjust the rate periodically. Whatever is negotiated. Usually it's on an annual basis. But they tie your rates to a market rate. Doesn't that sound familiar? We talked about this with a variable lease. They tie it to a market rate. But your interest rate in an ARM is tied to U.S. Treasury bonds, U.S. Treasury securities. I don't know if you're familiar with this. Have you ever heard of U.S. Treasury bonds? Okay. What they are is basically government stock. So you know what, Apple, give me McDonald's, they have stock, right? You can buy stock in these companies. Well, you can buy stock in the U.S. government. Those are called government treasury securities, U.S. Treasury securities. Anybody can buy these. But the rate of return, if you invest money with the U.S. government, varies from time to time. It changes over time. So on the anniversary date of you signing the loan documents, they're going to look at the new market rate, the bond rate. If that rate changes, what happens to your rate? If it goes up, what happens to your rate? Your rate's going to go up. Your interest rate on your adjustable rate mortgage loan. If the bond rate goes down, what happens to your interest rate? Actually goes down. It's adjusted up or down. It's not like a variable lease where it only went up or stayed the same. This is different. Now the nice thing about it is they usually have a fixed period. Let me mention this to you before we copy this down. They usually have a fixed period, like the first 5, maybe 10 years are going to be fixed. But after that, it's going to be adjusted every single year. And you roll the dice. Your interest rate in an ARM consists of these two parts, index and margin. Index is what I just described to you. It's the market rate. It's an economic indicator that is used to adjust the interest rate in the loan. And typically they link it to US Treasury securities. Index moves up and down with fluctuations in the national economy. That's the part that can be adjusted. Margin, which is also known as spread, just so you're not confused later on, is the part that remains constant throughout the loan term. Look, it's the lender's cost of doing business plus their profit and remains constant. That's the part that remains the same. The index is the part that's adjusted. And how do you calculate your interest rate in an ARM? You just add those two together. Index plus margin or spread. That's what you get. And they share features with you. I already shared these features. There's more regulation with these now than there was in the past. Let me mention something to you. The way that they make these look intriguing for a prospective borrower, if you're trying to go out and get financing and you see fixed rates at a certain amount, ARMs at a certain amount, usually the ARM is going to show up at a lesser percentage. And people gravitate towards that. But with anticipation, that's going to be adjusted. So yeah, the introductory rate, the teaser rate, you see they're trying to tease you, they're trying to lure you in. They get you on the hook, and then after a certain time period, it's going to be adjusted. So when you see fixed rates offered at 4%, you might see an ARM offered at 2% interest. And you're like, okay, I'd rather pay 2% than 4%, but it's going to be adjusted. All right. When we come back, we're going to talk about FHA and VA loans. Let's take a quick break. Just a quick 10-minute break. Stretch out, grab a snack, make a phone call, do what you got to do. 6:10. See you guys.
Right.
Can I talk to you for a second? Can you hear me? I can hear you.
Yeah. Yes. Do you have a question?
No, I'm just I just want to introduce me because I am a Linde student and I started like 3 weeks ago, and I decided to stop for 1 week because I had family coming over, and I don't know if they told you that I was going to join your class.
Yes. Yeah. One of our staff members informed me. So yes.
Okay.
It's a pleasure to see you.
Thank you. Nice meeting you.
Of course. Yeah. I'll see you
Yeah.
soon.
So is
Be
this
back.
class starting at 5?
Yes. Every single
Okay.
day. Monday through Friday. Sorry.
Okay. Thank you.
See you. If you pair those with one another, you can actually buy your primary residence with no money down. Now, if you get down payment assistance, this is not in the textbook, but I think I shared this with you before. They say you don't have to pay it back. It's free government money as long as you live in the property for at least the next 5 years.
But you're getting assistance from the government, right?
Yes. Loan limit. Is there an FHA loan limit? This is the question I get from time to time. You'll see it right here. It says the limits vary significantly depending on the average cost of housing in different regions of the country. So the average home cost in Central Florida, Orange, Osceola County, would be drastically different from the average home cost in Orange County, California. So the FHA loan limit might be higher in California than you would see in Florida, depending on the region.
Hello?
Yes?
Excuse me, Michael, can you repeat the part when you talk about the FHA loan? You said is something for the government as long as you live in the property for 5 years.
Yeah, that's down payment assistance. What you can do is, it's not in the textbook. It's just something I wanted to mention to you. But you can Google Hometown Hero program. Hometown Hero. Google that and you'll find out.
That's fine. Thank you.
And here's the thing. This money runs out. As soon as it gets replenished, usually every single year, people attack this program to try to take advantage, get that 3.5% contribution by the government. Yes, yeah. Well, I mean, as soon as it gets replenished, money is allocated per state, per county, then it's whoever applies to take advantage of this program, and that money runs out per region. You have to Google it. Yeah.
Okay, thank you.
Loan insurance premium. Check this out. Unlike conventional loans, where if you contribute at least 20% as a down payment, they don't charge you the mortgage insurance, right? For FHA loans, doesn't matter how much of a down payment you make, you still have to pay for mortgage insurance, no matter what. And you actually have to pay for 2 separate premiums. You'll see it here in front of us. It says FHA loans require 2 mortgage insurance premiums. The borrower pays a UFMIP, upfront mortgage insurance premium, one time, upfront. It's percentage based. That's not something you need to know. It's not in the textbook, but the lender would be able to describe that to you. In addition to the UFMIP, you also have to pay an annual MIP. But what they'll do is they'll be willing to roll it into the loan. So easy payments of 99.99, right? Anyhow, but they're still going to get their money is the point I'm trying to make. And it stays throughout the entire loan term. It's not like with conventional, after 2 years, they remove it, or you can request removing it. It remains throughout the entire loan term. Now, I did hear, a little birdie told me there was a rumor floating around that they're trying to get rid of that, where after a certain number of years, it goes away for FHA. But I don't know if that's official yet. Well, you can finance closing costs. So yes, if that's the case. And that's another great feature about FHA loans. Rather than paying for closing costs up front when you close on that property, you can actually roll it into the loan.
Closing costs you can finance.
You can you can finance the closing costs with FHA loans. So you can get 3.5% down, right, from the government. And then all of the closing costs that you might be responsible for, you can finance those as well, roll it into the loan. They just add it onto the loan amount. And then you pay over 30 years, which, I mean, it's a huge thing that you could take advantage of. And that's why these are so attractive to people. But there is a negative side of it. It's not all sprinkles and giggles, okay? Anyhow, appraisal. They do a special appraisal for FHA loans. It's called an appraisal inspection. The property is more so scrutinized when you do this type of appraisal inspection. And the property has to qualify for FHA financing. And if it's not habitable, or it doesn't have a certain habitable standard to it, they're not going to offer financing for it. Unless you do the FHA 203K loan, which you can finance renovation costs, which is nice, rather than paying out of pocket.
You can finance, oh, sorry.
Could you do an FHA loan for like a higher priced house?
Yeah. You might have to pay the difference though, because there's a loan limit for FHA. So if the loan limit is $500,000, but you want to buy a $600,000 loan or property with FHA financing, you just have to bridge the gap. But most people won't do that. Most people will, I mean, if you have the money, you can do it. If you want to get the lower interest rate and the other features that come along with it. But if that's the case, most people will go with conventional. Now is a good time to consider getting FHA financing because we're kind of transitioning to a buyer's market. Let me explain the downside of FHA financing. If you have 2 offers on your property, one offer is for conventional, the other offer is for FHA. They have FHA financing, the other borrower has conventional financing. And all of the terms are the same, except for that feature. One has conventional, one has FHA. Most people would lean more towards the conventional buyer. Why? Because to qualify for conventional financing, the barrier of entry is higher. It's more difficult to qualify for conventional financing than it is for FHA. So they view that person as more qualified to buy the property. That's one thing. And it's not always the case. I want to share that with you right now. Somebody might just prefer to go with FHA because all of these wonderful features. But if you're competing with other people, this is how it's scrutinized if they have conventional financing. Also, with the conventional loan, the property is not as scrutinized as it is with FHA. Remember, they do a special appraisal inspection for FHA loans. For conventional, they'll let a lot of things slide when it comes to the condition of the property. So if you're a seller and you have these offers, you might lean more towards the person who has conventional financing. Also, another negative thing about FHA financing, you want to give your buyer at least 45 days to close from the time the offer is accepted to the closing date because of all these conditions. For conventional, you might close in 25 days. So that looks like a more attractive offer, right? Hey, we can close in 25 days versus 45 days. Did you have a question earlier, Bruno? No? Okay. Let's continue to VA loans now. VA loans are also non-conventional. Conventional are loans that are not backed by the government. Non-conventional are loans that are. FHA is one. They were called FHA insured because they're insured by the government. VA loans are what by the government? Well, I skipped over it, didn't I? VA loans are what by the government? Guaranteed. They're partially guaranteed by the government. If you default as a borrower, the government will step in and reimburse the lender a partial amount. I mean, you're still going to have foreclosure on your record and everything that comes along with foreclosure, like we talked about yesterday. But it's kind of the same thing, right? You have the insurance and then you have this guarantee. They're both backed by the government. But these loans are for who? Who qualifies? Not just veterans, active, unremarried surviving spouses, unremarried. I think that's interesting, isn't it? So that means if you get remarried, you lose your benefits. And that comes along with a lot of the benefits that normally the spouse gets. If they get remarried, then they lose a lot of those benefits. Not all. Eligibility requirements is based on how long you serve for our country. You don't have to know the details of that. I'm just sharing it with you. Lending sources, not anybody can offer VA loans nor FHA loans. You have to be a VA approved what? Lender, just like you would have to be a FHA approved lender. Okay, here is the entitlement or guarantee. VA establishes loan guarantee limits, referred to as the VA loan guarantee or maximum entitlement. And it's the maximum the lender will be paid, provided the borrower what? Defaults. And statistically, I don't know if you've heard this or not, but I'm going to share it with you regardless. VA loans have the lowest default rate. Statistically, VA loans have the lowest default rate. And it makes sense because of the mentality of somebody who served for our country, that never give up, always fight mentality translates to all aspects of your life. And plus, if you're of the military, there's so much assistance that comes along with that. You get a housing allowance sometimes. So many different things. So let's continue on. Gamification of the system sometimes, but on page, I'm disabled. You know, it's like, okay, I just saw you surfing the other day. You're not disabled. Let's be real. Anyhow, on page 307, you can get multiple VA loans, by the way. That's what they're reusing entitlement. Is there a loan limit? No. VA loans have no loan limit, and they don't require a down payment either. Removal of the loan limit does not mean unlimited buying or borrowing power. It's based on your qualifications. But you don't have to pay a down payment, which is nice as well.
Payments are going to be so high.
It all depends. I mean, if you can afford it, then who cares, right? We haven't talked about that. You're way ahead. We're going to get there. They can charge you an origination fee of no more than how much percent? 1% origination fee. Okay, VA funding fee. Let me explain this to you. Do you remember earlier when we talked about FHA loans and how they were insured by the government? Who pays for that insurance? You as a borrower if you want to get an FHA loan. For VA loans, look at the last sentence. They do not require what? Mortgage insurance. They don't require mortgage insurance, but they do require that you pay something called a funding fee, also known as a user fee. What's the whole purpose of a user fee? Well, they removed it from the textbook. I'm sharing this with you right now. It's to help the government offset the cost of foreclosures. It's to help the government offset the cost of foreclosures. Isn't that the whole purpose of mortgage insurance? If you pay mortgage insurance, it's to protect the bank just in case you default, right? VA loans, they say, oh, we don't charge mortgage insurance, but we do charge you something called a funding fee, which damn near serves the same purpose as insurance, mortgage insurance. They just disguise it as something else. And if you have a service-connected disability, the funding fee is waived, which is a nice feature, but obviously you don't want to be disabled. We're going to come back to this qualifying ratio. And what we see next is closing costs. You cannot finance closing costs like you can with FHA loans. You have to pay them separately outside of the loan. Assumption. Are VA loans assumable? If you look in front of you, it says they do not contain a due on sale clause. So if it doesn't have the due on sale clause, are they assumable? Yes or no? Yes. The answer is yes. Even by what? It's in parentheses. Non-veterans. So if you know somebody in the military and they get a VA loan and you really want their house, you could potentially take over their VA loan with all the benefits that come along with being of the military and getting this type of financing. I mean, that's a pretty cool feature.
So you don't have to.
No, not for VA loans. I mean, refinance is probably the wrong terminology. Get a new loan to take over the original, no. For VA loans, they're assumable even by non-veterans, which is cool. If you go to page 308, last thing, I want you to highlight this prepayment. You could pay off as early as you like. I want you to highlight this chart. Understand the difference between FHA and VA. We talked about these already, but now I want to show you the handout that I distributed to you, the debt to income ratio. Oops. It should be in front of you, or in your stack of handouts. Should look like this. Debt to income ratio. We're going to talk about the HER, housing expense ratio, and the TOR, total obligations ratio. I already mentioned the purpose of this is to determine if you're pre-qualified for obtaining financing. We're going to see both calculations. I would say one is more so relevant than the other, but regardless, we're going to go through these, both. I told you we would come back to this. I think it's on page 299, if I'm not mistaken. Yeah. Page 298 and 299, we see the HER, housing expense ratio. You highlighted this? And the TOR on the next page, total obligations ratio. Be tested on one of those for your class exam. But at the bottom of page 298, you'll see the HER, housing expense ratio. 298 and 299.
Oh,
Yeah. But let's focus on our handout. Okay, I'll make it a little bit easier for you guys. Let me explain what the HER is. Housing expense ratio. It's used to calculate the borrower's ability to pay the housing debt, just the debt that comes along with purchasing the house that they're interested in. What type of housing debt might you be responsible for on a monthly basis? Principal, interest, taxes, insurance. And what if you can't, or you're unable to come up with at least 20% down? What might they also charge you? Mortgage insurance, right? And that's exactly what we see here. The calculation is as follows. You take your monthly housing expenses, which include PITI and mortgage insurance premium. We talked about why that might be the case. And you divide it by your monthly gross what? And that
You know
gives you the
what?
housing
Even with-
expense ratio.
Even with Oliver warming up, he wasn't that bad.
Hey,
I know he
Jaleesa,
missed
we
his
can hear you. Jaleesa, we can hear you.
I apologize.
Okay, let's make it up. Let's say the monthly housing expense, your monthly mortgage loan payment and your mortgage interest for that property you like is $2,400. I'm making it up. $2,400. Let's use that for our calculation. Everybody should have their calculator out. Let's work through this calculation together. Take out your calculator. And we divide it by our monthly gross income. I'm going to make it up. Let's say you're making $8,000 a month. Is that fair? Let's do the math. Take 2,400 divided by 8,000. Tell me what you get. You get 0.3. Now this is a ratio, which is a percentage, which is how much percent? It is 30%.
30.
But what does that 30% mean? Look up here. It means that your debt represents 30% of your income, right? So do you qualify? Well, that's what we see here at the bottom. I pulled it from the textbook and I put it all in one place for you, so you can study with this specifically. For conventional loans, look at the column that says HER. This is the maximum debt to income ratio you can have. You have to be below 28%. Are we below 28%? No, we just got 30. So we're not pre-qualified based on this calculation. Too bad, so sad. For FHA, are we
Yeah.
below 31%? Yes. And now it confirms what we talked about earlier. Is it easier to qualify for FHA versus conventional? Yes,
Yes.
you can take on
Yes.
more debt and still be qualified, is what it's saying. But, well, VA doesn't even look at this calculation. Here's the thing. It's not the end of the story for that person. You're asking them for this information. You can calculate, you can estimate what their monthly housing expense is going to be. And then you ask them, what are you making on a monthly basis? Tell me like your true monthly income. Everything considered, all streams of income. Share that with me. You do this calculation, you get 30%, but they really want FHA financing. I'm sorry, they really want conventional financing. You tell them, hey, listen, right now you don't qualify. So rather than pulling your credit and submitting a loan application, do you have more money to put down? Because if you come up with a higher down payment, that means the loan amount will be less. You're financing less, which means your monthly mortgage loan payment won't be $2,400. It will be less. And what if that $2,400 included mortgage insurance? Because you were unable to contribute, or you didn't want to contribute 20% down. But now you do want to put 20% down. So it's going to be a whole lot less, and you would qualify. Your income would be enough. So that's the game plan you come up with. It's a very important calculation, and a calculation you should practice with. Question. What do you mean?
Not about the mortgage, but like I'll include the insurance, taxes, how you should.
All of this information is available online. There's calculators, mortgage calculators that you can find on websites. You can plug in numbers and it will spit out a result for you. It's as simple as that. You have the tools. It's not something that you have to come up with. Now, in the past, when we first started teaching this class over like 20 years ago, we had a mortgage calculator that was used in class. We had to understand the functionality of a mortgage calculator. We don't have to do that anymore, luckily. Now, the more important of the two calculations is the total obligations ratio, the TOR. It's used to calculate the borrower's ability to pay all monthly debts, because it's not just what it costs to finance that house. Don't you have other debts in a month? The average person, don't they pay off other debts throughout the course of the year and every month? Yeah. So what we have here is we take your debts that you're responsible for on a monthly basis, including what we just calculated, right? Or we use this as an example, $2,400, plus long-term monthly obligations. In other words, what other debts are going to show up on your credit report that you're paying off every single month? Car,
Student loans.
medical bills, student loans, credit cards. All of this is going to show up on your credit report, right? So it could change this amount. All the debts you have in the month could be more. And the average person, of course, let's say it's, what is this? How much more? $800 more, right? Is that right? $800 more. So for all of your other debts that you're responsible for in the month, $800 more on top of whatever it costs to finance that house. So $3,200, all your debts considered in a month. Your income is not going to change. It's still going to be, in this example, what do we say, 8,000? Do the math. Take 3,200 and divide it by 8,000 and tell me what your total obligations ratio is.
0.4.
Yeah, you 0.4 or 0.4, which is how much percent? It's 40%.
40.
Now look at that column that says total obligations ratio. All three categories of loan, look at this column to determine if you're pre-qualified. So check it out. We're at 40%. For conventional, is that below 36? Are we below 36? No. So for both calculations, we're not considered to be pre-qualified. Not the HER nor the TOR. For FHA, are you below 43%? Good to go again for FHA. It's easier to qualify for FHA. And if you are of a veteran or of the military and you're a veteran and you want to get a VA loan, are you below 41%? Yes. So you're considered to be pre-qualified. Does pre-qualified mean the same thing as pre-approved? No. Okay. To get pre-approved, it's a little bit more extensive. You have somebody that's going to scrutinize all of your credit history, your payment history that's found in your credit report. Question, Kene, what's up? I made it up. But what is it comprised of? It's comprised of this. PITI, principal, interest, taxes, insurance. Just like up here, we just use that. Mortgage insurance, if you're responsible for it. And long-term obligations. So I just made it up. I said, your credit cards, your car loan is an extra $800 a month on top of what it costs to finance the house. Yeah. Not if you're getting a Hellcat or something like that. Yes. Yeah, because they're saying your debt cannot make up more than 36% of your income. Same thing. This is for HER and this is for TOR. This is just for the housing debt, just for financing the house. But this is all of your debts in a month. I'm going to tell you, in real life, they're mainly just going to look at the TOR. They're not going to waste their time because most people have other debts in the month, right? So they're going to want to know about all you. Okay, yeah, you can afford to buy this house, but do you have other debts? Okay, you have all this other debt in the month? Okay, well, wait a second. Let's take a second look at this. Now, if we go back to our textbook.
Have to memorize the.
Yes, you have to memorize those percentages. Sorry to cut you off. I'm so used to the question and I'm a psychic sometimes. All right, let's go to page 308 again. And at the bottom of this page, we see purpose-specific mortgage products. 308. And listen, a lot of lenders don't advertise this. You kind of have to know what you're looking for. And then when you Google it, you find out, oh, wait a second. My bank is offering this product because they don't like put it on a billboard. But if you know about it, there are opportunities that come up with these programs, depending on if you need this specific product or not. Biweekly is where you pay every other week instead of every month. You make your payments every other week, biweekly, every other week. What's the benefit of that? I'll just focus on the last sentence. If you're paying every other week, you actually are making 26 half payments in the year, to the equivalent of 13 full month payments instead of 12. So what does that mean? Well, it's going to save you considerable interest and you're going to pay off your debt sooner.
That's APR.
Yeah, especially you're making one additional payment every single year. So you're going to cut your debt that much quicker. It's not going to be a full amount. You make 26 half payments in a year to the equivalent of 13 full month payments. So you're paying smaller amounts more frequently. But let's continue to partially amortized, also known as a balloon mortgage. Let me explain this. I've offered this. I've taken advantage of it. I'm doing it right now. I bought a house in Beverly Hills, Florida. I just closed on it like a few weeks ago. You probably didn't know there was a Beverly Hills, Florida, first of all. But there is. And it's in Citrus County. And it's a 3-bedroom, 2-bath property, 1,530 square feet, has a garage, has a 10,000 square foot lot, has solar panels, a lot of nice features about it. I got it for $180,000. Okay, I didn't have to really do any work. It was basically ready to rent, which is what I like. And to make it even better, I did seller financing. So the owner of the property was willing to offer seller financing. We negotiated a down payment. We negotiated an interest rate. And we also structured it as what we see here in front of us. Now, we didn't do amortized. It's interest-only payments, but we know what amortization is. Amortization of a loan is where your monthly mortgage loan consists of the two parts, principal and interest. They change places. But we stipulated between one another, it still is a balloon mortgage. At 5 years of them being my bank, at the end of 5 years, I have to pay off the remaining debt. You'll see it right here. At the end of the stipulated period, loan balance is due, single payment, final payment called a balloon payment. They say at a loan maturity date. So basically, the owner of the property is giving me 5 years to cash them out, to get separate financing. Now, I did negotiate that for an additional $1,000. They'll stretch it out for another 3 years for me. So that works out as well. Anyhow, question. After 5 years of paying the owner, they want the remaining balance, whatever I owe. Yeah.
So they're your bank.
Yes. They're my lender.
Contract with a dual by a certain.
Yeah. I Zelle them, or if they have a payment system, or yeah. You could do it with your properties. I do it with my properties all the time. So a lot of people think the only way to buy this property is to qualify for traditional financing from a bank. No. So you can come up with this special financing terms, seller financing, and you can get deals done without including a bank at all. Negotiate all the terms. Some people don't realize that this actually exists in our business. And this is what I live in, the world of investing. That's the side I come from. And I take advantage of this frequently. I'd love to buy every property with seller financing if I could. Not deal with the bank at all, because the bank wants to charge you points. They want to charge you origination fees. They want to charge you closing costs. All of these fluff payments just to squeeze everything they can out of you. But when you're dealing with the seller, you don't see any of that. And my monthly mortgage loan payment for the seller financing is $700 a month. $700 a month. What can I rent it out for? $1,800. So I pocket every single month. It's cash flowing. This is the name of the game. This is how you play it. Anyhow. Well, you could paint it in various ways. Now, this person in particular, they were moving in with their daughter, and they just wanted monthly income. They just wanted consistent monthly income from that property. and they got me on the hook for 180,000. Maybe they bought it for a whole lot less. I think she did. But it's still affordable in my opinion. 3-bedroom, 2-bath house, $180,000. Cheers, you know. It worked out. Worked out for them, worked out for me. Purchase money mortgage. This is seller financing. I already mentioned that to you. Home equity loan. It's where you pull the equity out of your property as a loan. You get a loan against it. Almost every single lender offers this product. You have to qualify for it. You're getting a second debt against your property, though.
Well, that's it.
You're- Well, here's the thing. If it's 100% paid off, then that would be the case. Not the case for most people. Most people that take advantage of this, they pull out the equity so they can start a business, so they can buy another investment property. Whatever their case, it's not regulated. They don't care what you spend the money on. They just care that you're qualified enough to pay off this second debt you're creating against the property. They'll put a lien against your property as well. And if you stop paying on that, they can take the what? They can take the house if you foreclose.
Can you
Yeah, I do it all the time. Oh, on a house you own that you're living in? Oh, yeah, absolutely. Yeah. If it's an investment property, yeah. I mean, I'm doing that right now. I have 2 properties that I just acquired. I'm doing DSCR loans on them. And I'm getting I think I'm going to end up getting 7%. 7% interest. 30 years. I can share it with you. You have to qualify, of course, but I mean, it's okay. You have a question? All right. I could have sworn you said I'm going to rebel later. I'm going to rebel later. Okay. All right. On page 310. Have you heard of a HELOC, home equity line of credit? It's like a credit card against the equity in your home. You have to qualify for this as well. So they give you a spending limit. The spending limit is the equity in your home. If you have $100,000 equity, they'll give you a spending limit about 80%. So they give you $80,000 spending limit, and then you can basically, they usually give you a debit card, and you can spend that money on whatever you wish, and then you have to pay it back with interest, and then you can pay it back. It's like a credit card. Home equity conversion mortgage, also known as reverse mortgage or a HECM. It's designed for people over the age of what? 62 and older. What might it sound like when an elderly person coughs? It might sound like HECM. It's going to help you remember. I know I'm corny, just deal with it. So here we go. Check this out. This is for somebody who's over the age of 62 and they have significant equity in their home. And baby boomers, they usually view the home that they've been paying off for the last 30 years as part of their retirement plan. This generation, we don't really look at our home as something that we're going to eventually pay off. We buy properties usually every 7-8 years statistically. So we're not thinking okay, I'm going to pay this off in 30 years and I'll have a free and clear house. And then I'm going to borrow against it and pull out that money and play with the money, pay for expenses, medications, vacations, relaxation, all the Asians. But to each his own, right? Every person has their own retirement figured out. Hopefully, you're thinking about that now. The earlier you start, the better you're going to be financially when you hit retirement age. And who knows what's going to happen with Social Security and everything going on in our country right now. It's crazy. Besides the point. Here's the thing. Unlike ordinary home equity loans, the reverse mortgage, the home equity conversion mortgage, does not require repayment as long as you, keyword, live in the home. But once you pass away, because it's inevitable, if you create a debt against the property and your legal heirs inherit that property with debt attached to it, they're going to be responsible. And maybe that's the downside of this, right? You don't want to leave your kids, your closest relatives with property that has debt attached to it. You want to leave them something that's free and clear. Maybe you have life insurance that's going to cover it. I don't know. We're not going to get into life insurance. I'm in this dilemma with life insurance. And like, you watch so many videos about it. You see videos, people talking about, oh, it's infinite banking and all of this stuff and compounding this and investing that. And then on the other side of the spectrum, you hear very professional people say it's a complete scam. Well, Dave Ramsey, for instance. Dave Ramsey, you know who he is? Okay, he's like all about financial literacy and everything. He says, don't think of insurance as investment. Think about it as life insurance, because that's all it should be. Now, people leverage this program for investment purposes, but it shouldn't really be treated as such. And there's a point to that as well. So anyhow, do your research. I just wanted to vent a little bit. If you want to get a loan to purchase both real and personal property, like you want to buy a business with all the business equipment, this is what you should search for in Google. Who's offering a package mortgage loan? Package mortgage loan. All right, we're almost at break. Just bear with me. Go to page 311. We see something called the primary mortgage market. What is this? Well, I want you to highlight on line 3. The primary mortgage market is where new loans are what? Originated for borrowers. It's where loans are created. So where can you turn to get a new loan, essentially? Well, these are depository lenders, savings associations, and it tells you they invest in the bulk of assets in residential mortgages, home equity loans, commercial banks, CBs, construction loans for residential, commercial projects, and credit unions. Have you ever heard of a credit union? Fairwinds, McCoy. Yeah, all of these. They say they're nonprofit organizations. Yeah, right. But they finance residential home improvement loans. They charge just like any lender, right? But they're nonprofit. So I think that's quite interesting. What we just got done talking about is depository lenders. You might be confused as to what that actually means. It means that savings associations, commercial banks, and credit unions, they offer other banking services. You can actually go there and set up a bank account, deposit money, depository lender. But then we come across mortgage lenders, which are non-depository lenders, meaning that you can't go to a mortgage lender to open up a bank account, but they will originate loans. They offer loan products, like the loan products we already got done talking about. But for what? Primarily FHA and what? And VA. It's their focus. Types of loans offered. Well, residential commercial mortgage loans, FHA, VA. And why not FHA and VA? They're somewhat free from risk because they're backed by the government. They're non-conventional loans, loans that are backed by the government. I'm reviewing with you guys. Let's move on. We already talked about mortgage lenders. For full-service mortgage companies process, close, and sell loans they originate. You see, they sell their debts. They sell their debts. But doesn't every lender sell their debts? It's a big part of the business. We already talked about an MLO, right? Mortgage Loan Originator's License. Now I get to share it with you on page 313, the secondary mortgage market. What is this? I want you to highlight on line 4. Secondary mortgage market is an investor market that buys and sells existing what? You originate a loan through Chase, they're going to sell it. Unless you didn't need money from Chase. You had an 825 credit score, and you have tons of money in the bank, and you can verify that. You didn't need the loan, but you chose to use the bank's money because they gave you attractive interest rate. They're going to hold on to that as long as they can because they're thinking this person's never going to default. There's no risk. They got the money. They could pay off the loan tomorrow if they want. They didn't need us. But for the person that just barely qualifies and they originate the loan for them, they're not going to take the risk. They're going to get rid of it. But they don't just do it with you. They do it with a bulk of other people. They sell it in bulk to one of these three agencies, which you asked about earlier, whose sole purpose is to buy up existing loans. Yes, exactly. Well, it's three agencies. Come again? Well, it depends. Depends on the type of loan. FHA and VA are somewhat protected, but they're making interest. They're making money, okay? They're collecting your monthly mortgage loan payment now. If they own the debt, they're the ones collecting the payment. So they're making money. But in 2008, they were on the brink of collapse, these three agencies, because so much default at once. Now the financing regulations are different. The requirements to obtain financing are more strict. In 2008, if you had a heartbeat and a pulse, if you had air in your lungs, they're giving you a loan. You could basically say, I make $300,000 a year. Okay, this person makes $300,000 a year. What's your credit score? It's 760. Okay, 760. That's fraudulent because you have to verify all these things, but they weren't verifying it and there was not enough regulation to check. So people were getting loans when they shouldn't have. And of course, they defaulted. I mean, they shouldn't have been qualified to get a loan to finance a bicycle, let alone a $500,000 house. But that's why we saw the collapse. Watch that movie, The Big Short, and you'll see what I'm talking about. The Big Short. I mentioned this before. Now, Fannie Mae, these are just nicknames. These are not actual people. It's like Sally Mae, right? It's not an actual person. Fannie Mae is a nickname for what? What agency? Well, the official name is Federal National Mortgage Association, FNMA. You can kind of see how they got Fannie Mae out of that. Fannie Mae, right? What's some facts about Fannie Mae? Well, Fannie is the oldest out of the three agencies, established 1938. And guess what? Fannie doesn't have a preference, will buy up any type of existing loan, buys conventional and non-conventional FHA and VA. Okay. Freddie Mac. The official name for Freddie Mac is FHLMC, Federal Home Loan Mortgage Corporation. Don't ask me how they got Freddie Mac out of that. Freddie Mac, maybe because it's Fred, it rhymes, whatever. Freddie Mac likes to buy conventional loans, mainly, from small banks, credit unions, and savings associations. And Ginnie Mae is the only one out of the three. It's a government agency. Check this out. Ginnie Mae is the only one out of the three. It's a government agency under HUD and carries the full faith and credit guarantee of the U.S. government. Ginnie Mae only likes to buy government insured and VA guaranteed. Because why not? They're somewhat free from risk. You'll see it right here. Ginnie Mae, GNMA, Government National Mortgage Association. Likes to buy FHA, VA loans mainly. So this is going to blow your mind if you can understand what I'm saying. When you submit a loan application to try to qualify for a loan, those qualifications are not coming from the bank. Those qualifications are not coming from the bank. What makes you qualified is based on the qualifications that these three agencies set. Because this is what they do. Fannie, Freddie, Ginnie Mae, those three agencies that will buy the debt from the bank that originated the loan for you. They say, hey, listen, if you want to sell us the debts for these loans you're originating, those borrowers have to meet this criteria, like a checklist. If they don't meet these qualifications, we're not going to buy it from you. So then the lender says, oh, you got to meet these qualifications for us. But really, it's not for them. It's because they already plan on selling your debt. They know no matter what, if they originate the loan for you, one of these three agencies will buy it from them because it meets their criteria. Isn't that interesting? All right. We still got a little bit more time. So let me share this with you. Let's talk about the Federal Reserve System. Have you heard of the Fed? Anybody hear of the Fed? Let me share this with you. This is quite interesting. It's the central bank of the United States. That's the Fed. Established by Congress. When? 1913. It's not a date you need to know. But I'm going to share something with you. And the whole purpose of the Fed is to provide the nation with a safer and more stable monetary system. Yeah, they're really looking out for us. Here's the thing. It says, let me unpack this and tell you the truth. And this is all public knowledge now. It should be in the textbook, but it's not. Technically, it was established by Congress 1913 because they had to push it through as a standard for our nation, but it wasn't Congress's or some legislator's idea. This concept was made by major bankers and tycoons of that era. Just to name a few, J. Pierpont Morgan. Who is that? JP Morgan Chase. Aren't they still around? So they controlled financing. They controlled lending. They controlled money supply, right? What about the Rothschilds? Have you heard of them? Red Shields, finance wars on both sides. What about the Rockefellers? Own real estate, steel, oil, just to name a few. They created this concept because they wanted more control over the money supply in our economy. This is why cryptocurrency is such a popular thing nowadays, because it's a decentralization of the money system, the monetary system. But they wanted to have a centralized system to have ultimate control over money supply and how money is distributed in our nation. And to take it a step further, in 1971, if I'm not mistaken, we were taken off the gold standard, which completely ruined our country, in my opinion, because the gold standard limited how much supply of money was in our economy. And once they removed that, then we turned on the money printing machine. And that's how we climbed to this astronomical debt, $37 trillion in debt. Every 100 days is $1 trillion in interest our government pays. This is why Doge, have you been paying attention what a Doge is? Elon Musk and his task force, and eliminate waste, fraud, and abuse. This is why it's so important. Our government has never been audited in this way. And even if they have always failed. But there's no oversight, there's no regulation, there's no accountability. That's changing right now. So we're in a very special moment. I went in a different direction, but I wanted to share with you that this is our history. It's our unfortunate history. And those influential people that I talked about that created the Fed way back when, they had a secret meeting. This is documented now, off the coast of Georgia on a little island. It's called Jekyll Island. How appropriate. And there's a book that you should definitely read in connection with this. And it tells you a lot of, if you're a truth seeker like I am, I'm a truth seeker, I got to admit it. I love a good conspiracy, but I take everything with a grain of salt. It's entertaining. But if you're a truth seeker, read the book. It's called The Creature from Jekyll Island, something like that. Google that and you'll find it. The Creature from Jekyll Island. I think it's spell it Jekyll, Jekyll, something like that. It's spelled in a different way. Jekyll and Hyde, anyhow. The Central Bank of the United States, the Fed, the Federal Reserve System. It was established to create a centralized monetary system so they have ultimate control over the money supply in our economy and how money is lent out. Now, they have three responsibilities today, the Fed. Number one, conducting the nation's monetary policy. I'll explain that in a second. Supervising, regulating banking institutions, protecting the credit rights of consumers. yeah, they're really looking out for us. And maintaining stability of the financial system doing an impeccable job. Haven't you ever wondered why? If you're a truth seeker, this will resonate with you. We always have this continuous cycle in our economy, right? Every 30, 40 years, we do exceedingly well. The bubble bursts, whatever the bubble is. Now we know everything is a bubble, right? Before, the last thing that couldn't possibly be a bubble was the housing market. Turned out to be a bubble. Everything's a bubble. Sooner or later, the bubble's going to what? Burst. So we do exceedingly well. Eventually, the bubble bursts, whatever causes this bubble, stock market, housing market, whatever, financing. And then we're right back in a what? Recession, depression, Great Depression. They just changed the name, hoping that we'll forget about the past, but it's a cycle. And if you study history, if you know history, then they say history doesn't repeat, it rhymes. They have all these sayings. If you know what the past is, you know what to expect for the what? The future, and you can prepare yourself. In the same way that those top 1% of 1% benefits, you can benefit in the same way if you study these trends. What was that? They say that, well, there's sayings like history repeats itself, or it doesn't repeat, it rhymes, right? So the result is still the same. We end up in a recession, but it was caused by a different bubble, right? So it's like, that's the rhyme. And you could do the research on this. All of this stuff is available to you, but we don't change our habits. So that's the problem. I was so intrigued by this question. It haunted me. And I was always digging for knowledge. So I was on YouTube all the time. I was watching videos. There's a really good documentary you should watch in regard to this. And I'm going to recommend it to you right now. It's called Zeitgeist. Zeitgeist. Look it up. Zeitgeist. Zeitgeist. Just Zeitgeist Federal Reserve. Look that up. Put it in YouTube and watch that documentary. It's gonna blow your mind. Zeitgeist. I would say two things I watched like in the early 2000s really shifted my mindset to how things work. And it helped me become a truth seeker that I am today, because, you know, they say don't believe everything you see. And believe half of what you hear, right? Because the other half is an illusion. There's all these sayings, right? But it's kind of the truth. You have to, I mean, look what's happening with the news, with these huge news outlets, and them repeating the same talk track. And it's just crazy. But I'm going off topic. One was Zeitgeist. Actually, three things. I read a book, Rich Dad, Poor Dad. My sister actually recommended it to me when she was in high school. Rich Dad, Poor Dad, that changed my mindset. Watching, there was this national conference. It was like a committee with whistleblowers talking about UAPs. It was in the early 2000s, like 2001 or something like that. And national press conference or something like that took place in Washington. And the guy that was leading it, he's still around today. He's all over the internet now. He's like the godfather of disclosure. He's called Stephen Greer. I don't know if you've ever heard of Stephen Greer, but check this out. So that's one. That's actually two, the book and that. And then this one, Zeitgeist. This blew my mind. And then I'm like, okay, there's something going on here that's not known to the public. And if you want to know the truth, you go down this trail. I'm telling you right now. And then at the end, they get into speculation. At the end, they made some predictions. And one of the predictions is not that far off from what's going on right now. They said one world currency and inserting something in your hand that has all of your personal information on it. And some people, if you believe, you have a faith, you believe in the Bible, they call it Mark of the Beast, right? Have you ever heard of that? But if you go to Amazon or if you go to Whole Foods, can't you pay with your palm? You haven't seen this? You can go to, yeah. Well, I don't know about the face, but I know if you go to Whole Foods, even the one by me in Winter Park, if you go to that one in Winter Park off of Lee Road, you can put your hand out and it'll scan your palm to pay. Yeah.
How does this-
It's been around for a few years. Even a German company required all their employees to insert a chip in their hands so they can clock in for work and had all their personal information, and that's a lot of speculation there.
I was gonna
No,
say,
it's scanning your palm print because everybody's palm print is unique. But then, like, anyhow, I'm not going to make the connection. You can make your own connections, but it's very interesting.
Rich Dad, Poor Dad. That was a good book.
Hold on, guys. What were you saying online?
I was just gonna say to elaborate on what you were talking about. Rich Dad, Poor Dad. That's a good book. If anyone's interested in reading it, I read it. It's really good.
Yeah.
It changes your perspective on certain things.
Yeah, it's a mindset shift, and that's what you got to start with. You got to get yourself out of that wheel, that rat race, and that's how you do it. You digest things that help you shift your mindset. Anyhow, we could take a break, but the thing I want to send you off with is, if we have this constant cycle, what's the purpose? It's to enrich the few because they know this trend. They're aware of it. They prepare themselves for it. I watched this video and I was like, okay, they were interviewing one of these families, like the Rothschilds or the Rockefellers. And they asked them the question that was burning my mind, like, why do we have this continuous cycle? We do exceedingly well. Why can't we just do well all the time? Why do we have to have the bubble and end up in a recession? And their answer, they said, how do you think, and it was recorded without them knowing, how do you think the next generation of Rothschilds can build their wealth? Because if you know the saying, it's buy low, sell what? How do you make money if we're just always good? Things have to crumble so the people that are prepared can scoop up those pieces and build their wealth on the back of all of this. I don't want to say tyranny, but you know what I'm saying, right? All of this collapse. So it's very interesting. When we come back, I'm going to share some federal laws regarding financing. It's very interesting as well, but just take a quick break. Be back at 7:30. 7:30. Stretch out, grab a snack, do what you got to do.
Can you please unmute?
Okay, cameras on. Amari, Alianette, Josh, Dominique,
Yeah, I'm
thank
here.
you. Dominique, we got to see your face as well.
The thing is, it just keep off. I don't know what happened.
The other Dominique. All right, so where we left off, we're talking about federal, huh? Yeah. Okay. So grab a seat. We're going to continue with federal laws regarding financing. Federal laws regarding financing. And they're contained under the Consumer Credit Protection Act. We're going to learn several, starting with something called a COA. Let's learn some details about COA. When it comes to credit and financing, you can't discriminate for most reasons, even something that was excluded before. Look, I'm highlighting it. Even what? Age. Remember retirement communities, you can get away with that for housing older persons. But for financing, if you got an 18-year-old that meets all the qualifications to obtain financing, you can't deny them because they're so young. And on the other side of the spectrum, if you got a 90-year-old that wants to get a 30-year mortgage loan, you can't deny them because they're so old. And that's what we see here. There's actually more protected classes than that, but something you need to know on line 23. A COA, actually, no, it's right here on line 18. A COA was implemented by the Fed, we know who the Fed is, the Central Bank of the United States, under regulation what letter? Regulation B. Yes. Remember that, regulation B. It's enforced under the CFPB, Consumer Financial Protection Bureau. We saw them in a previous unit. You're going to have to know these letters associated with these laws. This how they might test you. For instance, they say the Equal Credit Opportunity Act is implemented under the Fed regulation what letter? And they'll give you A, B, C, D. You know, you'll have to know it. You'll see it for your homework tonight as well. On page 318, these are the other protected classes under a COA. Well, yes, those you'll see the core ones that we described previously: race, color, religion, sex. But then we add for financing, you can't discriminate against somebody if they don't have a specific marital status, like if they're married versus single versus divorced, and also sources of income that are included to determine if you're qualified for financing. Alimony could be used to get a loan. Child support even. Public assistance income, part-time. There was this, who got divorced? Kim and Kanye. He pays her $200,000 a month. $200,000 a month. Is that enough to get financing for a really nice house? If you can show $200,000 a month in income, yeah. And that could be used to obtain financing. Well, this is for financing specifically. When it comes to financing, issuing credit to somebody, like a loan, you can't discriminate for most reasons, even age. So it's to protect certain classes of people against discrimination for obtaining financing, specifically financing. Equal credit for all, right? And then childbearing mothers, you can't discriminate against somebody because they're pregnant. But then we come across TILA. This is how we say it in our business. TILA, the Truth in Lending You Money Act. At least that's how I describe it. Truth in Lending You Money Act. And you can add that to it just for reference because it will start to make a little bit more sense. The Truth in Lending You Money Act. What is this all about? See right here. It promotes the informed use of consumer credit. TILA regulates what information lenders make known to consumers about products and services financing, and requires disclosure about the terms and costs of obtaining financing from that lender. How important is it to know what the loan is actually going to cost you? That's what this was implemented for, to give you the truth in regarding to financing, the Truth in Lending You Money Act law. And we'll see the truths that are disclosed to you. What would you want to know about financing before you obtain it? Yeah, all of that. And we'll see details of that in a moment. But check this out. Look, this was implemented by the Fed under regulation what letter? Z. So the first one was ACOA, regulation B, because it's all about being equal, be equal, regulation B. But then TILA is regulation Z. And you have to memorize this. So what helped me memorize this is thinking of Tilla the Godzilla. Exactly. Tilla the Godzilla, regulation Z. So what disclosure is given to us when obtaining financing? Well, if you go to page 319, you'll see that information here. APR, annual percentage rate, which includes other costs that the lender charges you for. Full cost of credit, including total cost of the loan, amount financed, total payments, number of payments. All of this is relevant to us. TILA, this law, protects us against bait and switch advertising when lending money. Car companies are infamous for using something called triggering terms. Look at this right here. Car companies are infamous for using something called triggering terms, which include, here's examples on these bullet points, specific financing information that they're offering for vehicles that they're selling at their lots. You've seen it all the time on TV. You've heard it all the time on the radio. No money down. Interest rates as low as 0% for the first 6 months. And at the end of the ad, what do you hear? Somebody talking a million miles an hour, and if you don't have something to slow it down, how are you going to really hear what they're saying? There's no regulation on how quickly they say it, but when you slow it down, it's the required disclosure that they have to give you because they're using specific financing information in the ad, which are called triggering terms. And it prevents bait and switch because this is how it usually works with a car company. They're infamous for doing this. They bait you in with an amazing deal. When you get there, they say, oh, I'm sorry, it's not available. But you're here to get a car, right? Well, let me put you in a test drive of this car. You know, give me your driver's license and take you around. And you might end up leaving that dealership with a vehicle. That advertisement, which we know the intention of it, was used to bait you in. They say, oh, I'm sorry, it's not available, and try to switch you for something else. That's illegal. They're not supposed to do this. And that is covered under TILA, the Truth in Lending You Money Act. Here's the disclosure that has to be given if you're using triggering terms in your ads. Triggering terms is specific financing information. Anyhow, check this out on line 26. If you're using general phrases in your ad, you don't have to provide additional disclosure. Let me give you an example. You put a sign in front of your house that says 3-bedroom, 2-bath house, seller financing is available. You're not saying what interest rate you're going to offer them. You're not saying what qualifications they need. You're not saying how long you're going to finance it for. All you're saying is that it's available. Does that require additional disclosure? No. And that's what we see here. It's an exception to the rule. And last thing about TILA, it gives you the right to cancel financing. It's called a cooling off period. And they give you how many business days to cancel financing. It's on line 30. 3 business days. But does not apply for loans to purchase or construct a house. Only applies to these types of financing on the bullet points. If you try to get a home equity loan or line of credit, second mortgages, refinance loans, or a home improvement loan. You can sign the loan documents. They're not going to give you the money. They're going to wait 3 business days to pass because that's your cancellation period. After 3 days pass, Then they will give you the home equity loan, that money that you qualify for, or the second mortgage. And then we come across something we saw in Unit 5, RESPA. The real estate keyword is Settlement Procedures Act. In Unit 5, when we last talked about this, I described it to you. I said, this is the law that regulates the money that's exchanged when you close on a real estate transaction. And specifically, we were talking about referral fees. You remember referral fees, unearned fees? Are referral fees allowed in our business?
Yes.
Yeah. Between you and another active licensed real estate agent? Yes. What about to another agent in another state? Yes. But all the money goes through who? The broker, right? Can you give a piece of your commission to the seller or the buyer in the transaction? Yes, you can. Can you give it to a friend that refers you some business? No. TILA regulates. Also, can you get a referral fee when you bring sellers to a title company?
No.
A lawyer? A surveyor?
No.
No. None of those. Appraisal, none of those services, you can't receive a referral fee. If you have a mortgage license, can you make money off of that? If you have an insurance license, can you make money off of that? Yes. So RESPA regulates this. You'll see it here. By the way, is implemented by the Fed under regulation what? X. What helped me remember that is calling it REXPA. Call it REXPA. Kind of sounds like S, REXPA. What was that? B, yes, Z, and X. That's the ones you need to know for exam purposes. The law is designed to ensure that borrowers are informed regarding the amounts and types of expenses they're going to pay at the what? At the closing. How important is it to know what your closing expenses are going to be? How much it costs to close on this loan? This disclosure has to be given to you so you can prepare for the closing. Those of you who own property, you know this. If you don't bring enough to the closing, what won't you do? You're not going to close. And if you can't close because you're not ready, what could you lose as a buyer? Your deposit, liquidated damages to the seller. We talked about that previously as well. Let me show you. This is the last time we talked about it. You remember in Unit 5? Anyhow. Now, TILA and RESPA, as of October 3rd, 2015. You don't need to know that date. I'm just telling you. I remember when the law changed. It was a big law change. Because of what happened in 2008, 7 years later, they updated all of these laws. There was some implemented before that, but this was a big change. Now, TILA and RESPA have been integrated in one disclosure. It's called the TRID. Do you see TRID? Now, what's the whole purpose of this integration into one disclosure? It's what you're going to be tested on page 321. Excuse me. Thank you. You need to know the TRID rule. And what's the disclosure? Well, when you submit your loan application, the lender must provide to you within how many business days? No later than what? Yeah, third business day. Something called an LED. What does that stand for? LED, Loan Estimate Disclosure. Do you see that? I like to add that because then LED sounds like something familiar to us, right? You know what an LED light is. It's to enlighten you, right? It's to enlighten you. LED, loan estimate. But this is just the estimate of what the loan is going to cost you. It should fall within 10% of your exact closing costs to acquire financing, more or less. When do you get your exact closing costs? Can you take a guess? How many business days before the closing? You'll see it right here. At least 3 business days before the loan closing, you get a closing disclosure, and that creates something called a CD. You're not too young to know what a CD is, right? Okay, Kane, what does a CD stand for? Okay, what does a CD stand for? Yes. Compact disc. You're not too young to know what a CD is, right? Maybe you didn't grow up with CDs like I did and have the binder inside of your car and in the visor and make your own mixtapes and burn your own CDs. No,
I don't know what you're talking about.
it's okay. But online, she's like, I don't know what you're talking about. It's okay. You know, maybe you grew up on MP3s and streaming. That's okay as well. Do you know what a rotary phone is? What's a rotary phone? Show me what you do with the rotary phone. How do you dial numbers? Okay, all right. Well, he gave the action of spinning. I saw this video of like they were at a hotel, this family, and the dad handed the daughter a telephone and said, hey, can you call the front lobby to make sure they send more towels or something like that? And then he handed her the phone, and it has a cord on it. It's like old school phone. And she's like, what do you want me to do with this? Yes. What do you want me to do with this? Because she grew up with iPhone, touch, and all of this stuff. And it was very interesting. Phone books are gone. I think we're in the best I think I'm a millennial. I think we're the best generation. And the reason why is because we really get to appreciate the technology for what it is. The Gen Z, they take this technology for granted. It was hard times, okay? You know, you couldn't go on the internet if somebody's using the phone. I was around before like internet was a thing, right? So it's like AOL, right? You got mail, right? I didn't have cell phones were, two ways, pagers, all of these things. We got to see the evolution. So we see what it is now. We appreciate it. Generation these days, man. Imagine trying to text on a Nokia phone. All right. Like, any questions here? All right. We're done with this unit. I told you it was the longest unit in the textbook.
Michael, to add really quickly, my mom, who's Gen X, my sister, who is a millennial, and myself, who's a millennial, we actually have a podcast that we do, and we actually just did an episode on that, and it was called Bridging the Gap, because we kind of give our perspectives on that, and we talked about how much fun we would have burning CDs, and if they came out right without our computers getting a virus, we considered it a win. And how much we treasured those CDs versus, MP3 players. So it's funny to hear you talk about all of that stuff, because we literally just talked about that like a week ago. So
synchronicity, that's what we call it. You're in the right place at the right time. And now I need an invitation to be on the podcast. And complete silence, by the way. No. Do you remember yesterday?
Shortest episode? The shortest chapter, right? Longest and shortest.
14 is tomorrow.
Oh, he's back.
There you go. Now you remember.
Yeah. You're gonna jump.
This is the shortest unit. This unit takes me 5 minutes. Don't time me. No, you can I don't care if you time me. It takes me about 5 minutes. And it's the shortest unit in the textbook. Maximum 1 question on your state exam from this unit. Maximum. So you might not even be tested on this unit. Last one, different. All the percentages, if you go onto your dashboard and you see the materials tab on your dashboard for your student portal, then you'll see I included a candidate handbook. And with that candidate handbook, you see the percentages that come from every single unit that you're going to be tested on for the state exam. And you'll see the percentages that I talked about previously. Like unit 5, 12%. That's on the candidate handbook. If you go through it, you'll see it.
Mhm.
All right, Unit 15, the real estate market and analysis. At the bottom of page 351, you gonna clock me? Okay, let's start right now. We see physical characteristics of real estate. What's the first? Real estate is immobile. If it doesn't sell well in Kissimmee, you're not gonna move it to St. Cloud where you think it's gonna sell better. Even if you can pick up the house and move it, what about the land? Can you move the land? No, it's fixed. And land, for that reason, is indestructible. It's durable. Can't destroy the land. Land cannot be destroyed. You'll see it right here. Real estate is unique. This means there's no two properties alike. No two tracts are the same. This is called they're non-homogeneous. Homogeneity means they're the same. Non-homogeneous means they're not the same. There's no two alike. What about economic characteristics of real estate? Who has ultimate control of our market? Government. It's here in your textbook. I'm not lying to you. Thought I was like a conspiracy theorist earlier, and now we see some of the truth. The market is dictated by changes in our economy and controlled. These changes are influenced by the government. But it doesn't happen overnight. The market is slow to respond to changes in supply and demand. But do you actually know what supply and demand is? Do you know of the law of supply and demand and how that affects price? Do you know about the law of supply and demand? If there's a large supply of something and little demand, what tends to happen to the price?
Gets
Large
down.
supply, little demand. The price goes up or down? Goes down.
Down.
There's a lot of it and not too many people want it, right? If there's a high demand, little supply, what happens to the price? Think of
Goes up.
collectibles and so forth. Think about a can of Coca-Cola. Can of Coca-Cola is cheap, but if this is the last Coca-Cola
Uh-huh.
and it's ice cold and it's in the middle of the desert, I'm taking all bids, right? When Hostess was going to go out of business, do you know who Hostess is? Yes, exactly. They make them here in the United States. It's like baked goods, like sweets, and it's packaged in a box. Hostess. They make Twinkies. They're famous because they make Twinkies. You know what Twinkies are? Anyhow, it's an American treat. It's not good for you. Anyhow, Josh, you got to mute. Thank you. So Hostess was going to go out of business, the company that made Twinkies, and it's like a staple of American culture and all that stuff. And this was years and years ago, probably almost 10 years ago. And it turned out that they got bought up by another company. But when everybody thought they were going out of business, they were selling boxes of Twinkies. One sold on eBay for $30,000. Supply and demand. TikTok, right? When TikTok got banned, people were selling iPhones with TikTok and CapCut on it for 10 grand. Now it's back. And Citus. This is area preference. What's the most important thing to dictate value in property? It comes down to three things. Location, location, location. It's where we want to live based on job opportunities, preference, crime,
zones.
education, school zone, all of that. Go to page 353. I'm going to ask you a question. Do we as consumers have an influence on supply of housing in our market?
Yes.
No, because supply is dictated by availability of skilled laborers, construction loans, financing, land and materials. That's not us. That's not the end buyer. We're not a contractor. We're the end buyer. So we don't influence supply, but we as consumers influence what? Demand. Because demand is affected by us, the consumer. Price, what we can afford, population size of our household, our income, a mortgage credit that's available, and taste, preference, situs, S-I-T-U-S. On line 8, we need to know the definition of a household unit. A household unit, which is a dwelling space where a family can have privacy. You might remember this from the first day of class. We said residential is how many units? 4 units or less. What's a unit? A dwelling space where a family can have privacy. It's a housing unit, a household unit. And we see the definition clearly here. Condo, single family, just a dwelling space where a family can have privacy. Yeah, where they dwell, where they live. Okay, last thing I want to show you for this unit, go to the next page, and at the bottom, this is the bottom of page 355, we see on line 32 a seller's market, and on line 35 a buyer's market. A seller's market is good for who? Yes, it's not a trick. It's good for the seller. But when does a seller's market occur? When does it happen? When there's more what than what?
Buyers than houses.
More demand than supply. Now is the time to sell it and get the most for your investment. It's a seller's market. Sellers are in control. Buyer's market is good for who? The buyer. When there's more what than what?
Supply than there is
Supply than demand.
Then
What's
the
going on
names.
right now?
I was about to say,
Inventory has shot up, and there's not too much demand because interest rates are so high. When interest rates come down, it's going to change things.
I just saw
More
that.
buyers enter the market.
I just saw that there are over 2 million houses for sale in the state of Florida right now. So would you say it's a great time to buy in Florida?
I can't speak to how many houses are available, the inventory supply, but sometimes, like in the car industry, they say days of supply, like how long it sits on the lot before it's sold. And like properties are sitting in the market on average for like 170 days before they get sold. But it really depends on the location. For instance, I'll tell you, in Winter Park where I live, my area, houses are still selling. But same thing in Dr. Phillips. Same thing in like Windermere. Those areas, those little pockets where people, if you live in Central Florida and you got the money, that's where you want to move to. You want to move in these areas. And because they got money and they're moving from up north and so forth, they're buying. I mean, a property next to me just sold for $5-6 million. And it was on the market for not that long, a few weeks. So if we're talking about inventory, it's really between in a range. The average American, the average household, the average income, right? That those are the people that are not being able to buy because interest rates and so forth. And livable wage. Livable wage sucks right now. But we're doing better than Canada. Yeah, my mother owns a property in Bella Clínica. Yeah. I was going to buy a lot in Bella Clínica, and I was going to buy it from auction, and I was going to buy it for maybe $250,000 at the time. It was lakefront, Lake Sierra in Bella Clínica. No? Okay, I was going to buy it until I went to the clubhouse, and I spoke with one of the representatives of the community, and I said, okay, so if I buy this lot, are there any restrictions? Do I am I required to build, or can I let it sit there and just pay my property taxes? They said, not only do I have to pay a POA, property owner's insurance. So if there's nothing built on it, I still have to pay the HOA, which was, if you don't play golf, it's $40,000. If you don't play golf, you have to pay a one-time membership fee to the golf club, $40,000 if you don't play golf. If you want the golf membership, $80,000 one-time contribution. So I'd have to pay that on top of what I spent for the lot. I'd have to pay it was like $700 and something a quarter or something like that, $900 a quarter. That I have to pay that. I wanted to sit on it. I didn't want to build right away. I didn't even want to flip it. I just wanted to hold on to it. But I'd be caught up with all of these fees for no flipping reason. And they told me if I didn't build on my lot by like few months away from when I bought it, which it was like, I don't know, June. And then they wanted me to build by like September. I'm like, you give me 3 months to start the project? It was crazy. So it wasn't worth it at the time. Somebody else bought it and they flipped it, a friend of mine, because I told them about it. And when they flipped it, I was kind of jealous. Because
Yeah, and then you got the gold for free.
it was originally bought for $1.2 million. And it sold for $250,000 at auction. And then he ended up selling it to a Brazilian for, I don't know, like $500,000 or something like that.
How long ago was that?
It was a while ago. So,
2 years ago?
no, way more than 2 years ago. This is like we're still coming out of a recession sort of thing. And they're still, they pop up every once in a while. But now they're all scooped up by developers. Developers are in there like crazy. They bought up all the lots from auction.
He bought it like the gold. Because he bought it like before the project started, like in the beginning of the
Good for him. All right. We're done with this unit, but here's the thing. We do have time. So I want to propose something. I want to propose to squeeze in one other short unit. Takes me about 15 minutes to cover. Are you cool with that?
Of course. Squeeze in two more.
Yes.
Squeeze in two more.
I'll do one more. I don't want to overwhelm you, but let's cover unit 19. Yeah. Let's do unit 19. All I want you to do is the questions for unit 13. Unit 15, 19. I'm not worried about that. When we do the review tomorrow, we'll review unit 13 specifically questions. But let's continue. I mean, if you really want to, we got time. I could do 17 and 19.
Let's do it. That's what I'm saying. Might as well.
Yep.
And we just use another hour.
So the question she proposed was, does that mean we're not going to be here on Friday? Well, yeah,
Let's do it.
I'm serious. Happy birthday to you. You see this? She proposes something. Okay. So if that's the case, then let's start with unit 17 and then work to 19, okay? Sound good? Go to unit 17. I'll be brief here. I'll give you the bullet points. I'm not racing through this. I'm just telling you the most important parts. And this unit, very little that you're going to be tested on. So I'm going to show you only the stuff you're going to be tested on. Is that all right?
Yeah.
This is real estate as an investment. And when you sell businesses versus just selling a single family house, it's different. The transaction is conducted in a different way. There's things that factor into the value of the property that don't factor into a business and vice versa. So we'll discuss. We're going to begin. Well, you can highlight this. Go to page 392. 392. This is just terminology. It's term and definition. This is something that you can read through later on tonight. It's just terminology. Real estate terms. And you do have a glossary in the back of your book. And if you got the exam prep, which I know some of you already got, then you have flashcards there to test yourself with these terms, rather than spending the time to make flashcards yourself. Okay, here we go. Let's begin on page 395. Go to page 395. Advantages versus the disadvantages of investing in real estate. Advantage. Good rate of return. That's if the market is good and you know what you're doing. Because if you don't know what you're doing, you can lose money investing in real estate, right? So that's one advantage. Tax advantages, tons of tax advantages when you invest in real estate. That's going to be seen in Unit 18, which is tomorrow. We'll talk about that in Unit 18. Hedge against inflation. Rather than letting the money sit in your bank account, collecting dust, and losing your purchasing power every single year. How do you lose purchasing power every single year? Inflation. Inflation is when the cost of everything goes what? So you have the money sitting in your bank. Imagine you have $1 in your bank account. You don't spend it. You're saving that $1. Next year, that thing that you want to spend that dollar on is more expensive. So you can get less and less with your $1 bill every single year because of inflation. This is what we're fighting against right now. We're trying to stop inflation. But if you put money in real estate, what tends to happen to that investment? It appreciates in value.
Grow.
That's typical, but it appreciates, increases in value, depreciates, decreases in value. Equity is a good advantage. We know what equity is, right? The difference between what it's worth, what you owe. And what people will do is they'll pull out that equity to buy other properties or start a business, and that's called leverage. Pulling equity out of one to buy another. Hold on one second. Disadvantages. Lack of liquidity. You know what liquidity means?
Yeah.
Means you could sell it rapidly without like loss of capital. So real estate is typically illiquid, which means you can't just sell it whenever you want. It takes time. So the lack of liquidity is a disadvantage because you can't just sell it whenever you want. You can gradually get a return on your investment by renting it out over a time period. More localized market. Well, whatever happens in our local and national economy affect the value of the product that we're selling, which is real estate. We understand that concept, right? Like what happened with Pulse nightclub downtown Orlando. That local market, the houses surrounding that area, nobody wants to buy it because there's a shooting, right? But think of that in any city. And that's why those people that are in Silicon Valley buying up homes for a hedge fund, like Zillow Offers or Open Door. Have you heard of Open Door? Or Redfin. They're giving people instant offers for their home. They're giving maximum dollars because they see surrounding properties are selling for a certain amount, but they don't know that right across the street where that house is located, the one you're making an offer for, looks completely different. Oh, but it's close by, right? No, people don't want to live across the street because something happened. And those people that are behind a computer crunching numbers, they don't know. So they overpay, and now they're losing a lot of money. They're trying to sell these properties, unload them at a huge discount, 30%. Anyhow, expenses associated with expertise. If you don't know what you're doing, you got to hire somebody. They don't work for free. Like property management. If you can't take care of the property, you got to hire a property manager. Do they work for free? No.
No.
And relatively high degree of risk when you invest in real estate, if you don't know what you're doing. But I'm a risk taker. No risk, no what? No reward.
Okay.
You miss every shot you don't take. So if you're too fearful of the unknown, you're never going to reach where you want to reach. It's very elementary in my opinion. It's an opinion, right? But you got to know what you're doing. If you don't know what you're doing, then, and somebody loses a lot of money because they don't have any expertise, they took a risk, but uncalculated risk, they lose a lot of money, they have a bad taste in their mouth for real estate investment. But I know real estate is where you need to be. As far as any successful person on the planet has a real estate portfolio. Any successful, and they'll tell you the path to wealth and longevity, long-term, We're talking about passive income. We're talking about generational wealth. Real estate is the place to be. Creating competition for myself. But it's perspective. I have that perspective. I agree with you, but the next person might not because of a bad experience. Go to page 397. When you're selling a business, it's different. It's not like selling a single family house in a subdivision. There's other factors that have to be included when you're selling a business that people might not be aware of, like what we see in this chart. Similarities and differences. Selling a business versus selling regular real estate. What's the similarity? Well, it's the sale of property or assignment of a long-term lease. And what license is required if you want to sell real estate, a single family house, or somebody's business for them, a pizza shop? You have to have an active real estate license. For Florida, other states, you might not need a real estate license to help somebody sell their business, but Florida, you need it. What's the differences? Well, something called goodwill. Goodwill is up here. Goodwill is reputation of the business and loyalty of customers. How important is that to a business? Reputation and loyalty of customers? You're not going to see that for a single family house, but for a business, this affects the price, what you sell it for. Okay. What we see here, look, it's an intangible asset. You can't touch or feel reputation, but does it have a value? Does reputation have a value for a business? So when you're selling the business, if it has an amazing reputation, a lot of customers support that business, does that bring more value to what you sell that business for? Yeah. That's goodwill. And then going concern value is also another factor. So what is that? It's the value of an established business compared with just the physical assets of a business that has yet to be established. I'll give you an example of this. A new business versus an established business. Mom and pop New York style pizza just opened versus a Papa John's franchise. Which one is going to bring more value? Because we expect to go there for a certain quality of good and service, correct? And because of that system in place, that has value. It's easier to keep that business going than the mom and pop that you might not know what you're getting into. All right, go to page 298 or 398, excuse me, or 388 or 98? 98.
Right.
We see corporate finance, but under that we see business accounting. When you're selling a business, you have to prepare financials for the transaction and make those financials available to the buyer. Number one, income statements. You should know about it. It compares a company's income and expenses over a stated time period. Have you seen the TV show Shark Tank?
Yes.
Most of us love the TV show Shark Tank. If you've seen it, you probably would like it. They're investing in new businesses or established businesses, helping them grow. And we love to see the deals getting done on TV and these brilliant entrepreneurial ideas. What they tell these sharks who are going to invest is the income statement. They're saying it verbally on TV. That's good TV. We want to see that. What are you making? And you made how much over how much time period? That's the income statement. That's what investors want to know about. Same thing when you're helping somebody sell their business. So they need to prepare it, the seller. But even more important, have you ever noticed when you see a deal get done on Shark Tank, but then you don't see it available in the public domain? Like you see the deal get done, but then it's not available later on. What's going on here? What you might not know is 40% of the deals that they celebrate on TV don't end up panning out in real life. Because what happens is it's good TV to see the celebration and the deals get done, but they ask the sellers of their business to provide a balance sheet, which tells you the company's complete financial position. And it not only includes the income statement, but also the company's assets, liabilities, and the owner's equity. It tells you everything you need to know about the business before you invest in it. What does that mean? That means after they get the deal done on TV, the shark that invests sends their army of lawyers and accountants to meticulously go through all of their financials, the balance sheet, to determine if they're going to move forward with the investment. And a lot of them are just too much fluff, but not anything of substance.
So even though it's like a handshake and a verbal agreement, that doesn't mean that's.
And they know this beforehand because I had two friends that they were on Shark Tank. And one of them got a deal and on TV. And the deal didn't pan out because of what I'm telling you right now. They reviewed the balance sheet, which is not sexy TV. We don't want to see accountants crunching numbers. We want to see the excitement of the deal getting done. So it just didn't pan out. Oh, yeah. Here are the typical steps towards Australia, everywhere. On page 400, here are the 12 typical steps when helping somebody sell their business. These are the steps you would usually go through when helping somebody sell their business. We'll talk about valuation in Unit 16, which we're going to save for Thursday. And that's it for this unit. '19 takes me about, like I said, 10, 15 minutes. It's because I'm just telling you that we're going to talk about this in Unit 16. Because you might be curious, how do you evaluate a business? But we'll talk about it in Unit 16. I don't know, up to you. You want to knock out 19 and be done? We'll be done by like 8:30.
Let's do
Which is
it.
actually our break time. Is that okay? It's the last unit. I haven't gotten there yet. Our last subject for today, Unit 19, planning, zoning, environmental restrictions or hazards. Let's talk about what we see on page. Go to page 430. Luckily, our government has this philosophy of laissez-faire. Dominique, you remember when we talked about this? It means
Yes.
they let us run our business the way we want to. Of course, they tax us, but that's a different story. It's a beautiful thing about America. Now, if we move to page 431, highlight this, lines 1 through 4. Local governments, cities, municipalities, counties, they establish development goals called a comprehensive what? And I'm going to come back to that and explain comprehensive plan and how they implement it. Go to page 432. Under authority. We talked about this on the first day of class. The City Planning Commission, local government planning agency, has control over 3 things. Subdivision plat approval. You remember the plat map? The plans for a subdivision. Site plan approval and sign control. The actual signage for the entrance of the subdivision. They control that. Local government. So if you want to make like an entrance sign for your subdivision, it has to meet some requirements. Local government gets to dictate or approve it. Yep, exactly. That's why you don't see any LED flashing lights for entrances of communities. Page 433, we already talked about this. How many old ladies?
4.
Drive how fast? 35. In what zone? You got it. All you need to know to answer this is that conversion. How many square feet in an acre? 43,560. 4 old ladies drive 35 in a 60 zone. Okay? Question 91. It's one of your math questions. You got to know that conversion. I hope so at this point. Hope you remember it. Hopefully it haunts you. Go to page 434. Zoning. You know zoning? Zoning means everything has its own place. You can't just build whatever you want, wherever you want. So zoning ordinances, highlight this, line 3. I told you I would come back to it. Zoning ordinances are local laws that implement the comprehensive plan. And who enforces? Well,
I like the zoning.
county, police sometimes. It also regulates, check this out. Says zoning regulations control types of structures, allow lot sizes, building height, setbacks, how close you can build to neighboring properties, and so forth. We have residential zoning, which controls density or the number of homes that can be built per acre. And sometimes you might be thinking, looking at a community, they must not be regulating on this because the houses are flipping this close to one another. You've seen this, right? In Laureate Park, St. Cloud even, or like Celebration or Baldwin Park. I mean, you could put your arm out the window and hand your neighbor a cup of, something, give them dap because you're so close to one another. That's not the way I want to live. And being so close. My friend, he lives in Laureate Park and he's got this weird window that exists on the side of his house. And his neighbor has a weird window where when you look through his window, you could see the bottom half of whoever is in the house. You can look into their house. They're not covering it up. He's not covering it up. And all you see is the bottom half of their body. So you can imagine the stories that might come out of that, right? All right. Commercial zoning regulates intensity of use. You might be thinking, okay, it's zone commercial. I could put whatever business I want. No. That's why you can't build a gun store, a liquor store, a school, a church, wherever you like. Everything has its place.
No, it's not like that. Because you can do like a bar right next to a house, right next to a church. I'm so confused.
That's why it's.
You don't like it or you like it? Oh, okay, yeah. I mean, then you could build a gun store and a liquor store right next to a school. Is that okay? You know, it's like, in most Latin American countries, I'll tell you, go to Mexico, go to, Cuba, all these places. Anyhow, buffer zone is something you need to know. I want you to pay attention next time you're driving down the road and you see a shopping center with like a subdivision behind it. Look between the shopping center and the subdivision. You might see a strip of land that there's nothing built on it. It's undeveloped, but it's by design. It's called a buffer zone. They want to leave some space between two different types of zoning. Commercial, the shopping center, and the residential subdivision. But what does it buffer against? What do you not want entangling with the subdivision, family homes that the shopping center brings? Noise, traffic, population, pollution, some places prostitution. Let's move on. Building codes. What's the whole purpose of building codes? Protect the public's what? Health and safety from inferior construction practices. That's why they check for quality of workmanship. But how does the process begin? Go to page 435, look on line 14. Local government is the one that enforces what? Building codes. But the process begins by issuing what? Building permits after they review your architectural and engineering drawings. So if you want to build something, anything structural for your property, you have to get a permit. Have you heard of this before? You want to build a fence? You need a permit.
Yes.
You want to enclose your patio and put screen and a screen door and all of this stuff? You need a permit. You want to put a shed in your backyard? You need a permit. You want to turn your garage into a room? Permit. Replace a roof, replace a window. I had to pull a drywall permit one time because the county required it. A drywall permit. I was doing
Inside your
renovations
house?
on a property. Yeah, I was doing renovations on a property that I was going to flip. And somebody had called the county on me, like the code enforcement, and said I was doing renovations on the property. I'm doing renovations. Leave me alone, right? I'm making it look nicer. You should be happy. But no, they called the local police, they're the code enforcement, and they said, okay, well, what are you doing here? I said, I'm renovating the interior. They said, well, did you pull a permit for this drywall that you put up? I said, no, I'm putting up drywall. Why do I need a permit for this? Well, you need a drywall permit. So I'm going to write you this notice. You have to come pull a permit for it. It was the stupidest thing I've ever done. Couple of weeks. So it delayed my renovations by a few weeks. Meanwhile, I have carrying costs because they required it. But what purpose? Because it's the stupidest thing ever. Yeah, well, to pull a permit, there's money for that. You have to pay for a permit. By the way, architectural is how it looks. That's the aesthetic. Engineering is the structural. So they want you to prepare drawings like an architect, engineer is going to collaborate with, maybe it's the same person, and then you have to submit it. And think about how expensive that is to get these drawings created. It's not cheap. I'll tell you right now. But you get in trouble if you do unpermitted work and all of this stuff, whatever. I'm not going to get into it. Go to page 436. If you want to get permission to do something with your property that it's not zoned for, you have to request a variance. You submit a variance application with the city or county, whoever requires it. For instance, my neighbor, they wanted to build a pool. And you're thinking, okay, just pull a permit for the pool. But they needed a variance for the pool because of a setback. Do you remember I described what a setback is? No. How close you can build to the neighboring property. They have very limited space to build a pool. And they wanted to build closer to the neighboring property. You had to be at least 5 or 6 feet away from the neighbor's house, from their property line. But they wanted to build a pool closer. So they had to submit this application, go through this long process, and eventually they got what they want. The neighbors don't care. Like my neighbors, they didn't care. Do whatever you want, man. There's no HOA in my neighborhood. You want to build a pool closer to my property? Go for it. It doesn't bother me. And it didn't bother them. And they eventually got it, but it was a headache. All right, go to page 437. I'm going to share something interesting with you. Okay. Have you ever been driving down, let's say, a downtown area? Have you been to downtown Orlando? Downtown Kissimmee, downtown Windermere, Winter Garden, wherever the case may be. And when you drive through downtown, you see something that looks like a house, but it's a law office or a medical practice. And you're like, what is this all about? Do they have to build something that looks like a house in this area? No. The history behind it is that it used to be a house. People used to live in the city. There was no restriction on where you build your house. You could build directly downtown because imagine population, dirt roads, horse and buggy. But over the years, the decades, they say, okay, well, this is our downtown now, so it's going to be zoned all commercial. Only commercial property here, no residences unless you build like an apartment building, right? High rise. So legally, they can't force them out. If they want to use it as residential, they can't kick them out. It's in our US Constitution. You can't force them. And when they sell it, they can sell it as residential property too. The next person can buy it as residential. But as soon as they switch to the current zoning, what it's supposed to be, in this case, the example is commercial, they can't go back. Because now they're using the property for what it was intended, the future use as it was intended. Now, they call it legally non-conforming uses. So let's break it down. The name will help you remember. This person is legally not conforming, not complying with what it's now supposed to be used for. Because it existed beforehand and it's considered to be grandfathered in. Have you heard of grandfathered in? It existed before, the rules changed. All right, I think we're done. Let me see. Oh, one more thing. Environmental hazards. Environmental hazards associated with real estate. I'm going to run through this real quick. Have you ever heard of asbestos? Asbestos, which could be found in homes built prior to 78, is a fibrous material. And it's flame retardant. It resists flame resistant, flame retardant, fire resistant. You try to burn it, you can't. So builders got this great idea. With this fiber, if we put it on all our building materials, shingles, insulation, flooring, ceilings, drywall, we can build a wood frame house that's not going to burn down. So it's a beautiful idea, but what they found out later on is this fiber, the asbestos, causes cancer. And you'll see it right here. The fibers, when you inhale, it reaches a lung cavity and causes cancer. So now you can't use asbestos.
Don't want you to go when it comes to cancer, causing cancer, because you know how many things exactly, you know how many things we eat in this country that cause cancer.
Yeah. Yeah.
Even though
Okay,
water.
I mean, I know you can't really like.
There's so many things. Well, it works, but at what expense? Okay, I'll tell you. Want to know a conspiracy theory about lead-based paint? You want to hear it? Okay. All right. Lead protects you against radiation. You ever go get an X-ray? And they put the lead vest on you? Because it protects you, it blocks radiation. Same thing for Superman. Superman cannot see through what? His X-ray vision does not work through what? He can't see through lead. Through lead, okay? Anyhow, I'm kind of nerding out on you guys. So, houses were painted with lead-based paint because it lasted longer. It stuck better to whatever you painted it on. And, well, hold on. There was a threat in the nuclear age of our country, atomic age. Did you watch Oppenheimer when they created it? You okay? Radiation from nuclear fallout was a thing that people were worried about. And they're thinking, oh, if we put lead in paint, then you don't have to worry about any radiation entering the home. Does it make sense? You're protected within your home if there's a nuclear bomb in close proximity. Does that make sense? But they removed, but also blocks against not just radiation, but radio frequency, which is traveling through our bodies right now. It's an invisible frequency that enters in and out of our body. And the only way to block that as well is like lead as well. So it blocked out radiation and frequencies that could harm our body that we can't see, that are invisible killers. But they removed it. Why? Well, there's a conspiracy theory that it was removed not because of lead poisoning, because the cases were so few, but because they want ultimate access to our homes and what's going on in our homes. And if you look at the videos of the technology that exists in your cell phone right now, and when they scan your face and the radiation that's coming off of your phone, and with your cell phone, even if it's not on, if you leave the cell phone in the room, they can triangulate, they can ping it, and they can send a frequency out from your phone that bounces off all the walls in your room and can basically create a 3D image of everything that's going on in your house. They're spying. It would prevent the penetration. Huh? Right now, there's every conspiracy has a little bit of truth in it, right? And that's probably the best I've ever described it to a class, because usually when I describe it, it's very hard to describe this concept and for people to understand it. Wi-Fi.
crazy about something that they know is true.
Yeah. And there's well, that's called disinformation. And they send that out with the real facts to disorient the public. So they'll give you real disclosure, but then they'll say something completely ridiculous with that. So that way you're thinking it's all ridiculous. Like UAPs and USOs and UFOs and all of that stuff. I've been studying this stuff and following and researching it for like decades. And I have conversations with people and they think I'm crazy. And now I get to laugh in their face, okay? Because it's a thing. Have you been paying attention to what's going on? Anyhow. No, I don't. But what is gravity, right? Think about that. Is gravity what Newton thought it was? You know, dropping the apple from the tree and hitting his head, or is it density? You know, there's so many different things. Is it the warping of space and time? What is warping of space and time? We're on the fabric of space. You've heard that before. There's a lot of things. Blow your mind. In another life, I was like maybe an engineer. In another life, but my path led me to music and real estate. Anyhow, among other things. Mold. You know what mold is, right? Now, not all mold will kill you, but certain mold will when you're exposed to it in high concentration. Have you heard of black mold? How do you know if a property has a mold problem? It's very easy to identify.
You can smell it.
You can smell it immediately, right? When you enter the property, doesn't it just hit you in the face? You're like, there's a mildew smell in here. It's got mold somewhere. Check all the wet areas. Florida is humid, correct? So it thrives, it grows, it spreads. If you have a water problem in your investment property, I'm telling you from a point of view of an investor, you got to address it immediately. Don't waste any time. Even for your primary residence. If you have a water leak, don't waste any time. Fix it immediately. I'm telling you right now. It's going to cause so many problems. And in those spaces where it's dripping and so forth, mold is going to happen. It's Florida. There's little devices you can put in your house. You'll tell. And you can also get these devices. You can buy them on Amazon. And you can test the air quality in a home. And then you take this device, you pack it away, and you send it to a lab. And then they'll email you the results. And some people do this as a test before they buy the property. Because when they enter, they smell it. And they're like, there's got to be mold here, but I don't see any mold. So then they do the air quality tests. And then they say, this is part of the inspection. What's going on here? There's a big mold problem.
Well, they don't. It's like they don't believe the team.
Well,
They don't acknowledge the issue.
apartments. Yeah, apartments are tough because apartments, it might not be your unit, but you got the unit above you. And it's not just for water leaks, which is, I mean, somebody showed me a water leak that they had. It was crazy what they were dealing with. And there was so much mold on the ceiling and the landlord refused to take care of it. It was my previous student, the student in the last class. But what about wood destroying organisms? What about infestations? What about roaches? If you live in an apartment complex, a condo complex, you're clean, you take care of everything, you make sure nothing is left out for roaches, but then you still have roaches. What's going on? What's the problem here? It could be the unit right next. They could have the worst infestation and all the walls are connected, right? So you're sharing these walls with other people that are not taking care of their property. Got to address it. Yeah.
They're built really nice. They were built like maybe like.
Also, too, sometimes there's not good. So when you have mold in the ceiling of the shower, it could be the humidity and they didn't use the right products. They put drywall instead of Durock. It should have been like a different material to line the shower. They used drywall. They shouldn't have used drywall in the shower. Drywall absorbs moisture. Durock repels. And they should have been sealed. Yeah, you remember Unit 7? You remember Unit 7? If the landlord's not complying or if Remember, they have to keep the property in a safe and sanitary manner. It's not your fault, so they have to take care of it. It's one of their obligations. So first step, notify. They're still not taking care of it. 7-day notice of noncompliance. They're still not taking care of it. You say, well, I have the right to terminate the lease if you don't take care of this. And you would. If a house it has a well and a septic system, do you know what these are? Well water. You're pulling water from the ground to supply the house. And here's the thing. When I say well, most people think of like this big stone structure, like 6 feet wide with the lady from The Ring crawling out of it or something. A well is a like 1-2 inch pipe that's like 20, 40 feet down. And it's pulling water out of the ground because Florida, you dig far enough, you hit water, right? This water is very hard a lot of the time. Has iron, sulfur, it smells. You got to process that water before it enters the home. Otherwise, it's going to mess up everything in the house. Rust, all of this stuff. What else? So that has to be disclosed. And then septic. You know what septic is? So instead of a sewer system where you flush the toilet, you don't think about where it goes because the city, the county takes care of it. With a septic system, all that waste goes to your property. There's a tank in your yard to catch all the solids. You can interpret what the solids are. And then there's something called a drain field to disperse all the liquids. And that exists beneath the surface. It's in your yard.
What would you have?
Huh? Because the city, the county doesn't provide sewer. Or the neighbors opt in. They say, we don't want to pay for connection with sewer because there's an expense for that to upgrade everything. So we're just going to keep septic system. And you got to be disclosed that when you buy the property. Yeah.
My sister rents and in her water bill, she doesn't pay for sewage, but I do. She has septic.
Yeah. She has her own sewer system. Every property. Now, here's the thing. Hopefully your sister has lived in a property with a septic system because you got to know, and hopefully the landlord told her how to maintain that system. If you have ever lived in these homes and you don't know what you're doing, you're flushing stuff down the toilet, like the flushable wipes. You cannot do that. You those are not so flushable wipes, by the way. You flush those down the toilet in a septic system. The system, if it backs up, it will kick in reverse. And all that poo water from the tank will backflow into the house and come through every pipe in your home, every drain in your home. Your shower will fill with poo water. Your sink will fill with poo water. Your toilets will overflow. All of that stuff. It happened to my sister. She didn't know. And she was, and I told her, like, she has the flushable wipes on top of the toilet. I said, are you using these? Where are you putting the flushable wipes? Are you putting them in the trash bin? She said, no, why would I do that? I said, well, you're not flushing them down the toilet, are you? She's like, yeah, what's the problem? I said, you can't do that with the system. She didn't listen to me because whatever, I'm her younger brother. She don't want to listen to me. She calls me in the middle of the night, 11 p.m. Like, I can't believe there's poop everywhere. And she's like crying, hysterical. And by the way, even if you're on a sewer system, like a sewer system, you still shouldn't flush those. In the UK, have you ever seen the sewer system in the UK? Watch a video about these guys that go into it gets backed up all the time in London. Look at what they deal with. All the flushable and nasty wipes and so forth, and people flushing diapers and all kinds of weird stuff down. Yes.
Oh my God.
Marketing, yeah, I guess. You know what a wood destroying organism is? What's the first thing that comes to your mind? Termites. Did you know there's about 4 different kinds of termites? Yes. Did you know that wood destroying organisms is not just termites? You know there's other insects that will destroy wood in a home? Have you heard of carpenter ants? Carpenter ants. Have you heard of wood destroying beetles? They're called boring beetles. They bore through the wood. Yeah, even there's wood destroying fungus. And guess what? Here in Florida, all of it thrives because we're so humid and we welcome all of these wonderful insects into our lives. Unwillingly, of course. You have to get the home treated. I refuse as an investment property, I refuse to buy a wood frame home that was constructed prior to like 1990. I really don't even want to push that. Maybe before 2000, I probably wouldn't even do it. Just because I know there's such a high probability that if it's a wood frame home and it's older, it probably has termites. So anyhow, that's my experience with that. Any questions? We're done. We're done with this unit. Tonight, what's your homework? Just do 13.
13.
13 questions. And tomorrow's going to be units 14 and 18, and then we're done. Oh, no. 14, 18, and 16 are the last ones, right? 14, 16, and 18. Those are the remaining. We'll see how it goes. We'll see how it goes. I don't want to say we're going to, skip 2 days, but anyhow, you guys pushed it. And for that reason, at least Friday.
Didn't you say we were going to have a math review day, or we were going to go practice some more math?
Tomorrow's math.
Math. Okay.
Tomorrow's math.
Okay.
Have a great night. Cheers. Bye. Ciao.
See you.
Thank you. Good night.
Good night. Bye
Have a
bye.
great night. Adios.
Bye-bye.
Hasta luego.
Hey, Michael,
Arrivederci. Yes. Hey.
Michael, you mentioned earlier the exam prep? Is that
Yes.
something the folks have access to that now, or?
Yes. If you log into your account on our website, you should see on your materials tab, exam prep, the link, so you could register for it.
Okay. Check into that now.
All right. Good night.
So.
Bye.
Okay.
You too.